Good afternoon and welcome back to the Public Service Commission of South Carolina. We are still in the continuation of the hearing in docket 2022-89-G, the rate case requested by Piedmont Natural Gas Company Incorporated. We have a witness on the stand and we are in commissioner questions. Commissioner Carolee Williams. Oh, excuse me. Let's take a roll call. Thank you, Commissioner. Appearing virtually, we have Commissioner Urban, and present in the hearing room, we have Commissioner Justin Williams, Vice Chair Powers, Commissioner Thomas, Commissioner Carolee Williams, Commissioner Caston, and Chair Belser. Commissioner Williams, Carolee Williams, you're recognized.
Thank you very much. As others have said, Mr. Rothschild, it is nice to see you in person, and it's nice to be with everybody in person in this hearing room. So I appreciate your being here.
Thank you.
I have a follow-up question from your conversation with Commissioner Williams. And that is within your range for ROE of 6.98 and 8.74, you all talked about one principle that I heard that we might use to consider, to evaluate if we wanted to consider your range more carefully, and that was gradualism. Are there other principles or rationales that that we should think about? Because obviously that's a very broad range. And the way I heard you say it is you gave us a midpoint really more for discussion purposes. And correct me if that's wrong, but that range was statistically and financially what you would recommend. So what principles, what rationale do you suggest that we consider beyond gradualism in thinking about anything within that range or really within any of the potentials that we have out there for return on equity?
Okay, thank you for the question. One important thing to emphasize is that range is already removes some of the outliers on both ends. So I think that should be taken into consideration as well. It's not just a very...
For clarification, are you talking about your own outliers or others that that other entities have proposed?
My own results, yes. I'm going from the 698 up to the 874. It's already excluding some of the outliers. So this is what I believe the market data is saying that would enable the Piedmont to raise money within that full range. And yeah, the midpoint, I guess, would say is kind of for discussion purposes, but I think that's a reasonable number given the balance of all the data. You have to pick something, but it's important to say that range, that's what the financial data is saying would enable the company to raise money, and the commission could consider that wide range. I think other factors to consider other than gradualism, I think for choosing, so I think your question is really that's within that range. How could you justify towards the low end, middle, or the top end? That's a good question. I think that I just tend to feel more comfortable going with the middle just to be safe. But again, that range is already cutting the high ends. I think maybe just appreciating what capital markets are saying since this to maybe consider. And the one development is that the cost of equity for gas utilities seems to be coming down even more. You can see that they've been outperforming the overall market. So you may want to take into consideration this data was the end of June, but as we see that gas utility stocks have been performing well and other indicators that the cost of equity has been coming down. So just kind of keep that in mind as a greater confidence that range is a solid range, enabling the company to raise money. So I think that although that's not giving you maybe an exact number within that range, it's just I think you should feel that the data is indicating that that's very, very solid and feel confident that they would be able to raise money if they.
And my question was more about principles and principles from a financial, but also a legal perspective for consideration. So do you want to add anything to that?
I guess I think I'm repeating, but I think it's just that this should be really market-based. I think that's a very, the best way to look at setting the appropriate authorized ROE. I think that's consistent with the legal standards and also makes sense because that's the money that's where the utilities are getting their money.
Now, I apologize if somebody else has asked this, but you've mentioned a few times that your data is based on information as of the end of June. Was there new data the end of July that you would want to put in the record? Have we already covered that?
I have run some numbers, and if that would,
I'm asking. How did they change?
the cost of equity has been coming down for gas utilities, so that would be something that, as a witness, I would be happy providing if that would.
Could you
be okay.
provide a late file exhibit on that? Is that within the realm of?
Madam Chair, this is obviously, any information along these lines would be information that we have not had an opportunity to see and won't have an opportunity to see it until it's filed. And I question, my concern is that do we have to then reconvene the hearing to review this updated information, and do the parties have the right to submit counter information and then cross-examine witnesses on it? That's my concern.
So are you objecting?
I'm not usually in the practice of objecting to a commission question, but I think in this instance, yes, ma'am, I think I have to lodge that on
Sustained.
behalf of my client.
Thank you for the education. Appreciate it. No further questions. Thank you, Mr. Rothschild.
Good afternoon, Mr. Rothschild. Thank you for your testimony today. You performed the DCF and the Capion models, is that correct?
Yes.
And you did a couple of different variations of each model, is that correct? And under your non-constant growth on the cost of equity, your range went from 925 to 947, I believe it was. Is that correct?
Let me double check. That sounds right. Yes, that's correct.
And yet, you've discounted that, and I'm taking from your response to Commissioner Williams as an outlier?
Yes, what I've been doing for a number of years is look at kind of a 75th percentile. I don't think we should take any one data point too seriously, and we should look within a broad range of results. And that's why I've been consistently talking about, in terms of a 75th percentile, as a good way to hone in on a central tendency of what the data is saying.
Well, and I know you explained constant growth and non-constant growth, but can you explain that to me in layman's terms?
Sure. The difference between the constant growth and non-constant growth is the following. The constant growth uses one growth rate that you assume goes out in perpetuity, just one. And a non-constant, you would have one growth rate for a period of time, and then you could have a terminal growth rate. What is sometimes done is you'll use a growth rate for the first 5 years, and then I've seen using a GDP growth out in the future. So it's just looking at one growth rate going to another, and that's what I do for this. I do it over the course of a period of time, and then I have a terminal value.
Well, and when you're talking about growth rate, tell me that's growth rate in the market and what is that a growth rate of? Because I'm used in utility regulation, I'm thinking about a customer growth rate of adding additional customers during the time that these rates might be in effect.
So when an investor, in terms of the growth rate, when an investor buys a stock, they have two ways of making money: the dividend, the payment, so the dividend yield component, and then the growth of the capital gains of the growth in the stock price. So that's what it would be looking at as the growth in the stock price.
So you just, because you use the 75th percentile, you just discount the highs and the lows.
Yes.
But that doesn't mean that that's not a good indicator, does it? That non-constant growth DCF?
I feel that it's too high given all of the other evidence. The non-constant growth that I uses a lot of the different figures from value line that I think is helpful as one indicator, but why then is it so much higher than what stock options are indicating? To me, that indicates there may be some kind of inconsistency or something with the information that is maybe producing a result that isn't as reliable. In some cases, I've thrown out the non-constant because it's been too low, and one of the concerns I have is it doesn't include the growth of common stock. So it might be like in my constant growth DCF, there's a component that I have. It's not just the expected growth rate and the dividends and the earnings that comes into the growth. I also look at the growth component from the sale of new common stock, just for example. And so sometimes I thought, well, the non-constant growth is coming out too low, but it's not including that component. But sometimes the non-constant growth may have other issues. So I tend to think if one of the models is that far out of line with the others, I tend to think it might not be an indicator. So I like to look towards a central tendency, because with I think the models are very helpful and objective, but finance is not like physics. It's not going to be so precise. That's why we talk about a range, and I think this is to bring off some of the outliers there and bring it down. I think is more a range that's more representative of the market-based cost of equity.
I think one of the things that piqued my interest is because that was on the high end, yet under the CAPM risk-free 3-month T-bill, that seemed to be the low end of your models, yet part of that range was captured in your recommended range.
The 633?
The 633 to 7.9, there's part of that range that was captured by your 698 to 8, by your recommended range. Even though that was an outlier on the low side, part of that range was captured in your recommended range.
I consider on the low and the high, I consider the 947 as and the 633 equally in terms of determining that range. I considered the non-constant growth. I didn't exclude it from the consideration in developing this range. So I didn't go as low as 633. I went to 698, and the same there. I didn't go as high as 947. I went to the 874.
But all I'm saying is, you took part of the range from your low side, but none of the range from your high side.
It was in terms of looking at this range. I did take the 75th percentile. So I did not include the 633. I considered it. I didn't include the 947, but I did within that whole range. I went to the 75th percentile. So they both were impacting on the high and low. I didn't exclude the high and include the low because I wasn't biased in that way. I did consider the 633, but I did consider the 947.
Okay. Thank you very much. Appreciate it. Commissioner Thomas.
Thank you. And anyway, so I had a chance to do a little bit of thinking while while I was eating, and just wanted to throw a couple of things out there again, and this all relates to the equity component of the calculation. And as we've covered before, your recommendation was 44.58%. But you said you could look at it conservatively and you could see that even 50% would be okay. And so I was just kind of looking at the numbers a little bit, and I calculated an average of the four proposed numbers. Piedmont started out at 54.56, and the low one was the energy users at 50.92. Anyway, so if you put yours in there at 44, and you come up with an average of 50.57, if I did the math correct. And that 50.57 is very, very close to the 50% that you said could perhaps be a reasonable conservative number. Do you think even pushing it as far as 50.57 would still fall into that perhaps reasonable conservative range?
I do. I think that would be fine. I just my real concern is just to make sure that the utility companies are justifying their capital structure as much as possible. And I know that picking within that range is something that is challenging. But I think that I do think that being extra conservative 50-50, but as you said, adding those, I think it was 50.57, would be close enough to be, in my view, a reasonable compromise.
Okay. So help me walk through the impact, because you've mentioned several times that when these numbers are too high, then customers are overpaying. So let's talk about the equity component here and how that flows through. Let's just say that if we went with something close to your original number of 45%, or if we said, no, not to that, let's go close to Piedmont's original number, which was approximately 55%. So let's just say that if we went with Piedmont's 55% compared to your 45, how does that flow through in just kind of hopefully a simple explanation? How does that impact the customer bill?
So what we had discussed on that one chart earlier, or table on page 9, table 3 of my direct. Do you want to look, or I can keep talking?
You can keep talking.
Okay, so that includes the difference of the both capital structure and rate of return. So it might be that you'd want to see this table keeping rate of return constant, but I think this will help to just say here the difference is $11.6 million. When you look at the difference between my 44.58% common equity ratio comparing to 54.58 for the company, and looking at the difference of ROE. So the difference there is 11.66. So from there it would change the revenue requirement. Depending how the rate structure works, that would impact each consumer's rate. So that's the kind of dollar difference we're talking about in terms of the impact on consumers' rates.
Okay. And really, I was kind of more thinking in terms of a simple step by step. This is how the numbers are calculated. Just boom, boom, boom. This is how it kind of flows through.
I see. So I start by looking at the requested rate base, which is $505 million. I believe in the settlement slightly less, but we're about $500 million. And then, and I apply. I should go here to. I get an overall at my midpoint, the 7.86 ROE. The weighted overall cost of capital is 5.76. That's when you take the cost of equity, multiply with it, and get a weighted. Now you have to gross up for taxes on the equity portion, and so that I don't have that number right in front of me, but that gets would get grossed up instead of 5.76. It's in the sixes. which you have to do to calculate, and then from there you apply that to the rate base, and that's how I get a 34.58 million. The rate of return portion of the revenue requirement, if my recommendation is adopted, and if Piedmont's original request, it would be 46.24 million, difference being 11.66. And in terms of grossing up for taxes, I use the federal income tax rate of 21% and the state income tax of 5%. So that's how, so rate of return, grossing up the equity portion, applying it to the rate base. Those are the steps.
Okay. Thank you. So I was taking a look at the handout that is Piedmont specific that Attorney Jeffries handed out shortly before we broke for lunch, and just taking a look at the numbers on there, and again focusing on the capital structure, the equity side. So just starting at the top, North Carolina is 51.6% equity, and that was back in January 22. And then South Carolina has been 52.2, and Tennessee back a little over a year ago was at 50.5. So even within the same company, you see the variability that can happen with regards to the capital structure. And if you look at that, then Piedmont was the high one in that chart. And in your opinion, all else being equal, could that potentially cause South Carolina customers to pay more than the customers in the other states?
Yes, I think that just doing that math, it would require consumers to pay more, and my real objective is to make sure that the regulatory capital structure should be in line with how the company is actually being capitalized, as opposed to just being manipulated or changed to increase rates. And so I guess to answer your question, yeah, the math would be that they would be paying a higher rate, all else equal, with leaving ROE the same, higher than the other states if they had a higher regulatory capital structure with a higher common equity ratio.
Okay. All right. I think that's all I had. I appreciate it.
Okay, thank you.
Thank you.
Commissioner Caston.
I have a follow-up, and actually listen to Commissioner Carolee Williams' questions and Commissioner Thomas. I actually had similar question, so I don't want this to sound repetitive, but I'm going to ask it anyway because it's the way I was thinking. I was thinking in terms of really two different things, but we've talked about gradualism or incrementalism, and I think the terms band of reasonableness and such as that. And I can't remember whether it's Commissioner Thomas or Williams talked about South Carolina Energy Users Committee recommendation, I think of 50.92 equity and 49.08 debt. And I think that was based on the national average. Do you recall?
Yes.
Okay. And ORS recommendation, I think Mr. O'Donnell, I think just took the 2021 RSA, and that was 52.2% equity and 47.8% debt. Do you recall that?
Yes.
And it's funny that Commissioner Thomas mentioned the handout because I really didn't know this, but that's what I was thinking too when I looked at this that Attorney Jeffries gave us. North Carolina, the common equity was 51.6, which would make it 48.4 debt. Is that correct? And
Yes.
I did the math right?
That sounds right. Yeah.
I'm usually pretty good with the real easy ones, but let's see, South Carolina, it was 52.2% common equity, which would make it 47.8% debt. And in Tennessee, it's 50.50 common equity, which would make it 49.50% debt, correct?
Yes.
So as I look at all these, and including, these, Attorney Jeffries handed out, while they are different than the band you had, is a concept such as gradualism or incrementalism relative to capital structure, does that make sense?
Yes, I think it would apply equally as to ROE.
I'm sorry?
It could apply equally a concept as ROE.
And if you're thinking in terms of, based on just the information I gave you, which is in the record, including the 51.6, 52.2 and all, are those, if there is a band of reasonableness, and we're also talking about if it's gradualism or incrementalism, would you consider what I just read in the record as in a band of reasonableness?
Yeah, it could be. I would believe that I feel that as close to 50-50 as possible would be the most reasonable, I think, at this stage, given what I've seen on the record. And my only concern, I think, about just using authorized capital structures in other jurisdictions is that's not at the consolidated level, and we have a chance of issues with that because it's either a chance for manipulation or other issues over time. So that's my only concern with looking to those other numbers. So I think as close to 50-50 as possible would be the most reasonable.
It was 50.5 equity and 49.5 debt. Is that better than 55% equity and 45% debt?
Much better, much closer to something that would be reasonable and could be argued to be in consistency with gradualism.
Similar question, if it were 52.2% equity and 47.8% debt, is that better than what was proposed, even in the stipulation?
It's certainly better, but I think that is certainly on the high side given the evidence, but certainly much better.
All right, thank you. I have no more questions.
Thank you.
Thank you, Commissioner. Commissioners, any other questions? Commissioner Irvin?
Thank you. I understand that you use stock options as part of your analysis. Could you explain to me how you consider stock options in your model?
Yes, I consider stock options in the calculation of two aspects of my CAPM, but I also provide it for additional insights to capital markets. I'll start with the CAPM. First, I use it to calculate my betas. So I use the stock options traded for each of the companies, and I first go through a sorting process that's identical to how the Chicago Board of Options Exchange does to sort out and make sure that the prices are relevant, that are basically real prices, as opposed to just stale data. And then after I've have all those prices, I go through a process of calculating implied volatility based on standard methodologies and implied skewness. And implied volatility is maybe been familiar with the VIX index, which is we I calculate the implied volatility just like the Chicago Board of Options Exchange calculates the VIX index. That's implied volatility, which has to do with what these options say regarding how wide it expects a range of potential swings in the market. When that implied volatility is higher, that means investors think there's a greater possible swings. When it's lower, a lower possible, tends to be more in terms of lower risk. The skewness looks at how much investors think that probability distribution is skewed one way or the other, because you think you have a normal distribution, which would look at the mean and median being the same. When you have skewness, you have a mean and median that's different. And so when we take implied volatility and implied skewness based on the research in this area, it gets the implied covariance of the market in terms of the relationship with the implied skewness and implied volatility. Comparing that for each of the individual companies to the overall market, that's an indicator of going forward what investors expect the covariance to be in the future.
And as I understand it, you only look out about, 90 days?
Look out 6 months is what we focus on for the option implied betas. And Mr. Coyne brought that issue up because the research had said it may be better for cost of capital to look out further, whether it's what they're called leaps, so going out over 1 year, 12 months, or 18 months. I have addressed that issue, and in Sir Rebuttal I showed by looking at, I can't go out any further than the 6 months for gas utilities because those stock options don't exist, but they do for many electric companies. So I addressed this issue by using stock options of electric companies, and the results show, and I want to just refer to where that is in my Sir Rebuttal testimony. That is on page 18 of my Sir Rebuttal testimony. Chart 2 shows that for these electric companies, when you go out to 18 months, the option implied beta declines, is lower than at the 6 month time frame, which this is the research that the academic research done in 2008 did not do, but I have done this, and shows here that it's conservative at this time to be using a 6 month time frame. Conservative meaning it tends to indicate a higher cost of equity than if we went out to the 18 month time frame.
Well, here's my question. Is this a generally recognized model for establishing how a stock is going to perform in your industry and your expertise?
Using stock.
Is this something you came up with?
No, I base all of the various pillars of this are based on exactly like the Chicago Board of Options Exchange. And in terms of the option implied beta portion, that was based on research that was done starting in 2008. In terms of using stock options to measure investors' implied or investors' expectations regarding volatility and skewness and many other measures is very common. There are literally thousands and thousands of papers that address this issue, and the Federal Reserve Bank of Minneapolis provides some very interesting continual implied probability distributions based on stock options in a very similar way.
You would agree that many of these options are very thinly traded when compared with the general market. Isn't that true?
For gas utilities compared to, say, options traded for Apple Computer or for the S&P 500? Is that what?
Yeah, just generally speaking, it's a thinly traded market compared to the larger market. Is that correct?
Actually, for stock options, it's a larger market than for the underlying. Actually, it's crossed in recent years. There are more stock options traded. And it's unbelievable, but the popularity of stock options has been so big that they're more than for the underlying.
Well, let me ask you this question. that's a relatively short lookout, 6 months. How do you think that would be a reliable indicator to just only look 6 months ahead, particularly understanding that the option decreases in value as it reaches the strike, the contract deadline, right?
The 6 month time frame is certainly an important issue that we've considered, and the paper that we based the research from 2008 found that 6 month option implied betas were a much better representation of future historical betas than historical betas. So you could say, well, it'd be nice to have for all these companies the 18-month forward betas that we have for some electric companies, and we don't. But 6 month option implied betas that research shows are far more representative of the future than these 5-year historical betas that are commonly used in utility proceedings. I think it's a much
close. Excuse me. If you're close to the end of the contract and the value of the underlying option is out of the money, how do you give that any credence or credibility?
if the option is close to expiry. Is that?
Yes.
Okay. When we look at 6 months, it's when the VIX calculates it's a 30-day. That's the common a 30-day term structure, and it's always 30 days. Now, how do they do that? Because there's not only for any one second or 1 day is there any option that actually expires in 30 days. There's usually ones that expire in 27 and say 32 days. So they do an interpolation to get to 30 days. So it's always 30 days. When we do 6 months, I do the very same thing. I take the options that expire in a little less than 6 months and a little more and continually get 6 months. So I'm never looking at the options that expire in a couple days. That's actually a very good question because you get a lot of, that's what I do see, you get a lot of funny, kind of, and it's funny, but you get a lot of distortions when the options are expiring in just a few days. So I think that's an excellent point, and I don't use those in the analysis. Yeah.
Okay. Do you consider yourself a technical options expert? Follow technical analysis? You train with that?
Am I trained with stock options?
Yeah.
I got my master's degree at Vanderbilt in finance and we did stock options there.
Do you trade options yourself or for your clients?
I have done some option trading, but mainly when I speak with quants and work with quants who do specialize in options, yes.
Well, for example, how would you take into consideration the fact that many investors that own the underlying stock will write covered calls on that stock for extra income? Is that reflected in your analysis?
Yes, that would be fine. If there certainly are investors writing covered calls. That would be.
But they already own the stock, so that's not an indicator that they think their stock's going to go up. In fact, it may be hedged in the event it goes down. They've covered it, right?
I think, especially when you're dealing with any kind of securities, you never know what the overall portfolio is of an investor. You may have, what's often with options, people could buy calls that expire in 4 months and write calls that expire in 7 months and all kinds of complicated arrangements. And
That's right.
And it's an important concept that we're looking at. We're really counting on that if there's any kind of arbitrage there, you must have a good market, right? So I think that's what you're getting at. Do we have data that really represents investors' expectations if you have some doing various different types of trading strategies? And so it's very important in what is the underlying of the research that I see with stock options is that if, regardless of the reasoning behind traders, including investors who could own the stock and be writing covered calls, if that pricing is off in any way, there are investors who are going to look for arbitrage opportunities. if you have an open market, that I think it should represent investors' expectations.
And so, many investors use straddles, in a strategy trade, but that would skew your results as well, wouldn't it?
No, I don't think so.
Why not?
Because again, if you have people doing straddles or any kind of very complicated trading strategies, there are investors continuously watching, if you have an efficient market, to look for any kind of arbitrage opportunities, which would set then collectively the expectations of investors. The same would go for the underlying stock. I mean, if you're using the underlying stock and you get rid of options, you say options aren't reliable, I'm just going to use stock prices in a DCF, you have to consider the impacts of the options on the underlying stock as well. I think it would apply the same to the underlying stock.
And you're telling us that this is being utilized nationally in the United States as a way to project investment opportunities or momentum. How do you exactly use this information?
Well, it's interesting the Chicago Board of Options Exchange publishes the VIX. I think they update it every 1 minute, and people use that as a quote fear index. So as it goes up, people tend to say this means there's greater fear in the market. So people use that. People use the VIX, the skew index published by the CBOE to look at the probability of what the option implied probability of the downside risk for stocks is. And like I said, the Federal Reserve Bank of Minneapolis publishes implied probability distributions for stock price movements for the S&P 500 and others. It was very interesting what they showed during the pandemic. The probability distribution is very interesting. I think that was important for investors.
I'm just wondering though, if we're setting a ROE and structure that's supposed to hold for a year or more, why should we rely on 6 months of data?
I think they are, well, on the option implied betas, I'm using 6 months with the gas companies because they're just, it's not available any longer. But on the portion of, I use stock options on the risk premium portion of the CAPM, and I go out as far as possible. And now we can go out, I think, as far as 54 months. So that is, you're getting out now issuing close to 5 years. So I think that's very relevant and far superior to 5 years of historical betas that are commonly used.
I appreciate your explanation. Thank you. No further questions.
Thank you, Commissioner Irvin. Commissioner Justin Williams, did you have questions?
No, ma'am.
Oh, I'm sorry. I thought I saw another light down there. Commissioners, any other questions? Any redirect, Mr. Hall?
Make sure I got this working again. Can you all hear me okay? All right. Mr. Alston, I just want to maybe just kind of clear up a couple things and maybe just point out a couple others. I think one of the best commission questions I've heard earlier was from Commissioner Powers, and remind me of the job interviews we've been doing at GCA recently. But you were asked about the weaknesses in your models, and I believe you said needing enough data, and that you, I believe you said, and correct me if I'm wrong, that you compare companies that have a little bit of data to those with a lot. And do you test those differences?
Yes, I've done some tests to compare the results of option implied betas for some like water utility companies that have lower. Actually, in this case, I was looking at option implied skewness for different utilities. I think it was water utilities and some others that had relatively small amount of stock options to electric utilities that had extremely high amount, thousands and thousands of outstanding contracts. And I was getting very similar results. And given that these were all utility companies, I think it's a really strong indication that there is enough data, even for the utility companies that have relatively less stock options, that we're still getting reliable results. If they weren't reliable, you would expect to see something very different or chaotic compared to the companies that have a lot of stock options. Just not seeing that. I'm seeing that the evidence is showing that they are reliable, even for the ones that have less stock options.
Thank you. There was a lot of discussion of concerns with storm costs, and I believe you mentioned securitization as a way to deal with that. But I kind of want to tie back. I think a concept that's maybe got a little lost is well, first let me back up. I'm sorry. You're aware of storm reserve funds, that some utilities have storm reserve funds?
Yes.
And that is another way for utility to kind of set aside some money in event of a storm.
Yes.
So back to the next point I was going to try to make is, I think it's getting lost, is we have cap structure, we're talking about cap structure, but there are actually two components to the overall rate of return. The return on equity we've been talking about, and the cost of debt. And the cost of debt is not in dispute in this case, is that right?
That's right.
So, and in order to get the overall rate of return, you talked about the weighted average cost of capital. That's how we get to the overall rate of return. But debt can be used to pay for storm costs as well.
Yes, the company could raise debt. Yeah.
Yeah, and debt is cheaper to consumers than equity.
Yes.
And as a simple example here, we're talking, about ROEs from 7.86 to 9.5 or 9.9, and a cost of debt of 4.08.
Yes.
And you talked about this a little bit with Commissioner Caston, and I believe Commissioner Thomas also mentioned it about the ROR and true up, and how this potential credit down rating could impact Piedmont's cost of debt. Mm-hmm. And I guess with my previous questions, we do recognize that Piedmont would still have to a bank would still have to be willing to lend money in order to, to get that debt to pay for storm costs. And certainly we don't want to jeopardize that. But I want to try to give a simple example that demonstrates what you all were talking about. And I believe you said it, but just maybe without concrete numbers. So if we have a 50-50 cap structure, and you have a 9.5 ROE and just for simplicity, 4.0 cost of debt. So very similar to what's being requested here. What's the rate of return?
What would be the
overall rate of return on a 50-50 cap structure?
9.5 times 50. So yeah. Okay. So
well,
anyway, you can
check.
do
Would you agree?
9.5 times 50, weighted with 4% times 50. Yeah.
Would you agree that's 6.75?
Yeah, that's right. Yeah.
So similarly, if you lower the return on equity, there's this concern about, will that impact our cost of debt? And nobody's we talked about there hasn't been any calculations of this. Nobody is concerned, but did a conservative number. So lower to 7.5, cost of debt goes up to 60. You still have a 50-50 cap structure. Subject to check, would you agree that's also a 6.75 rate of return?
Okay. Yeah.
And similarly, and maybe that's over there under the conservative, an 8.5 ROE that raises the cost of debt to 5%. At a 50-50 cap structure is also 6.75.
Yes.
So regardless, at least for the company, overall rate of return, 6.75 across the board. But I believe you told Commissioner Irvin that consumers would actually benefit, in your opinion, with the lower ROE, even with a higher cost of debt.
Yes, from what I've seen, it hasn't even been close. Of course, within reason, you wouldn't have the company take on 90% debt, but certainly within reason, close to the capital structures being actually used at the consolidated level by utility companies. Yes, when you talk about moving within those reasonable ranges, it hasn't even been close. The numbers I've seen, consumers benefit, and as Mr. O'Donnell had said, he said that was an argument that's been a bogus argument that's been promoted by utility companies for years, and I think he saw a ratio of 8 to 1 We have a 7 or 8 to 1. I think it was 8 to 1 in terms of consumers benefiting by $8 and benefiting on $8 by the reduction in capital structure and cost of $1 for the increase in the cost of debt.
And you talked to Commissioner Thomas about the tax true-up, and that would come into play in this situation as well, wouldn't it? Because I'll let you answer. Would that be a benefit to consumers to have lower equity?
Yes, the impact on rates is much more than just comparing, if an example, 8.5% cost of equity compared to a 4% cost of debt. The difference is really greater because you have to gross up the equity portion for taxes, and that bringing 8.5 would be, I think, almost certainly over 11% in terms of after you gross up for taxes.
And the higher the ROE or higher the capital structure, inevitably that's going to be a higher true up, more taxes that are going to have to be paid.
Yes.
It might just about do it. You were asked about. Actually, let me ask you something else. So with Commissioner Belzer, there was a question, and I think you answered, but I just want to make sure it was clear that you did include the 6.3, the low end 6.33 in your analysis.
Yes, I included it when I look at all the numbers and do a 75th percentile. I included equally the 633 and the 947 is what I think is what her question was. I was trying to answer.
And I just want to make sure that this, from your testimony, accurately addresses that concern, because I do think it was a valid one. On page, this is page 24 of your direct testimony. Is this highlighted portion, does that capture what you were just explaining?
Yes, I see. Yeah.
And finally, there was a question about compromise and settlements and you know, Piedmont coming down to a number and you know, perhaps other give and take. In your experience, do you see often that does it seem that utilities ask for a higher number and then will settle for a lower number?
I see that often. Yeah.
That's all the questions I have. Thank you.
Thank you.
Mr. Jeffries, very limited.
Thank you, Chair Belzer. Just two areas I'd like to cover real quickly, Mr. Rothschild. You remember you were talking with Commissioner Williams. It seems like a while ago now, but and you raised a concern about that Piedmont's customers may be overpaying. Is that, you recall that discussion?
Yes.
Okay. And now Piedmont's current ROE is 9.8, right?
Yes.
And that in this state, and that's 31 basis points above the stipulated return on equity, correct?
Yes.
Did you audit the books of Piedmont as part of your investigation on this proceeding?
No, I'm speaking in the context of my testimony as a rate of return expert, not auditing the company.
Okay, so you don't know if the company is holding excessive retained earnings or engaging in excessive dividends to its corporate parent, do you?
No, I know they're not paying any dividends recently.
I'm sorry?
I know they're not paying. I haven't paid dividends recently to Duke. They've not paid dividends.
Did ORS audit Piedmont's books to your knowledge in this case?
Not to my knowledge.
You're not aware whether the...
No.
Okay. If ORS had audited Piedmont's books, do you believe they would have made note to this commission that if Piedmont...
Madam Chair, I want to object to the line of questioning. He's asking him to speculate, and I think this is beyond any of new information that came out in cross or questions from the commission.
Madam Chair, Mr. Rothschild has at several points today suggested that Piedmont's customers are overpaying for the cost.
He also stated that in his testimony numerous times, and so it's nothing new. You could have asked him about it in your initial cross-examination.
I'm responding to commission questions and his response to commission questions, I believe.
We're going to allow a little leeway. Let's wrap it up.
Thank you.
Madam Chair, just her very briefly. I just want me.
Thank you.
I just want to the extent, obviously, just to the extent any of this mischaracterizes what ORS did, I just like to object to that. But
I think he
he can't speak to the audit we did necessarily.
correct. I think he said he didn't. Did he say he didn't know or know that they didn't? I think he said he didn't know.
That's correct.
Okay.
So I have one more question. If you believe that the ORS found evidence that Piedmont was either retaining excess earnings or engaging in inappropriate dividend practices with its corporate parent, do you believe they would report that to this commission in this proceeding?
I don't know anything about the audit.
Okay. Thank you. Thank you.
All
Madam
right.
Chair.
Mr. Rothschild, thank you for your patience today and thank you for your testimony.
Thank you very much.
Madam Chair, can I raise one minute? One of the exhibits that was used on Cross, my understanding, it was not a complete document. It's the S&P Global Market Intelligence, that report. I was going to see if that complete document could be made a part of the record instead of just the one page.
It was the,
Mr. Rothschild, Mr. Jeffries, do you have the complete document?
I do, and I'm happy to offer that.
Do you have
into
copies of
evidence.
that?
I do.
Can we substitute that in hearing exhibit? Was that 9?
And I've already provided these to council.
Okay, thank you.
Thank you, Madam Chair.
Thank you for getting that cleared up. Mr. Rothschild, you may step down.
Thank you.
Give one a court reporter, please. And this is just replacing the front and back document that was in hearing exhibit 9. It goes as part of composite hearing exhibit number 9. Okay, before we call our next witness, I'd like to ask for some clarification. In response to Commissioner questions, Mr. Hall, you started giving a description of what you thought the settlement agreement allowed and did not allow. And I think that raised some issues. So, I want to hear from all parties here about the issue that was addressed in Commissioner questions about what is allowed and what is not allowed by the settlement agreement with regard to ROE and capital structure. You with me with what I'm asking, Mr. Hall?
Yes, and as I said earlier, I'll try to state what I did before and let other counsel correct me if I'm wrong or give their opinion. As far as what is allowed or not allowed by the stipulation, obviously it does not prevent the commission from doing anything it wants to. From the party's perspective, my understanding is if the commission regarding the stipulation can accept the entire stipulation, including the 9.49 ROE and the 53.5% equity component that all the parties except for DCA agree to. Alternatively, you could accept the remainder, take away everything but the ROE and capital structure that all 4 parties have agreed to, and substitute your own ROE and cap structure. I'm not sure there aren't more than 3 options, but those are sort of the
Is that 3 or 2?
3. You
Can accept
scrap
it?
anything you want. Get rid, any of the adjustments that you care to change that are not reflected in the stipulation. ROE, that's your discretion. All the parties have, so option 1. Option 2, accept the entire agreement with all the adjustments that ORS, SEUC, and Piedmont agree to, and the 9.49 and 5.35 equity. Third, accept all the adjustments that all the other terms that all 4 parties agree to, but substitute your own ROE and cap structure.
Okay. Mr. Jeffries, does Piedmont agree with that characterization?
I would characterize it slightly differently, Madam Chair. I think the commission conceivably could look at the stipulation and pick parts of the stipulation, maybe an accounting adjustment that the parties have agreed to, and the commission looks at the evidence and says, well, no, I don't agree with that. So that would be, and I think there are probably not an infinite number of variables there, but at least as many issues as is resolved by the stipulation. So I don't view it quite the same way that the Department of Consumer Affairs does. But I think the salient point that we were discussing earlier is sort of what happens if the commission doesn't accept the ROE and the capital structure that are reflected in the settlement agreement as between ORS and SEUC and the company. And the company agrees that that if the commission does not do that, that at least from the company's perspective, we don't feel like we have the ability to walk away from the entire stipulation, because those issues were specifically reserved for litigation in front of the commission.
Okay, thank you. Mr. Elliott?
I agree with Mr. Jeffries.
Microphone. Thank you.
I agree loudly with Mr. Jeffries.
Thank you, Mr. Elliott. Mr. Huber?
We agree with Mr. Jeffries' characterization.
Thank you. You agree with that, Mr. Hall?
Yes, I do.
Okay. Commissioners, are there questions?
Yes, ma'am, Madam Chair.
Commissioner Justin Williams?
And I'm sorry, folks, for being a little dense here, but I just want to make sure I understand exactly what you're saying. The commission, in relation to the stipulation, the commission can make any decision regarding ROE and capital structure, and the other terms that are included in the stipulation will stand no matter what our decision may be on ROE and capital structure. Is that what I'm understanding?
Yes, I believe so. The agreement was that those two issues, capital structure and ROE, would be carved out for determination by the commission. Obviously, three of the parties have a settled result that we would urge before the commission, but I agree with your statement, Commissioner Williams.
And just going a little bit further, that means that our decision on the two items that we're litigating, regardless of what we decide, have no impact on the rest of the stipulated items in the stipulation presented to us on Monday.
I think that's true as long as you accept the other stipulated results that are reflected in the stipulation.
Okay.
And if I may speak a little further, Mr. Jeffries, and I think part of the issue came with paragraph 24 of the stipulation. And so based on what you said, if the commission declined to adopt two of the accounting adjustments, that's when the language in paragraph 24 that states, if the commission declines to approve this stipulation in its entirety and without modification, then any party may withdraw.
I believe that
language only applies to the parts where all four parties agree. Is that correct?
That's correct.
Okay. I don't know if that helps or confuses. I hope it helps.
And I would agree with that.
Okay, thank you. Y'all agree, Mr. Hall and Mr. Huber?
Yes, ma'am.
Madam Chair.
Okay, thank you. Okay, Mr. Hall, anything else from DCA?
No, we rest our case. Mr. Rothschild is excused, correct? Yes.
Okay. Mr. Huber, no witnesses to put up at this time, correct?
Madam Chair, I believe we are on to there was two additional company witnesses.
That's where I'm headed next. I was just making sure. Mr. Jeffries, Mr. Hessling, or Mr. Rich?
Yes, we'd call Mr. Chris Bauer to the stand.
How are we on time? We've been going about an hour. Does that make it clear as mud now? Just be careful. Mr. Jeffries, are you comfortable there? Because your witness is having to look over his shoulder to see.
I'm happy to use the
I mean, I just am wondering for his sight line if it might be a little easier at the other one.
I didn't want to be infringing upon Mr. Cooper's space.
I don't think he would mind.
I apologize. Has the witness been sworn? Okay.
Would you please raise your right hand? Do you solemnly swear that the testimony you'll give in this matter will be the truth, the whole truth, and nothing but the truth?
I do.
Thank you.
Good afternoon, Mr. Bauer.
Good afternoon.
Could you state your full name and business address for the record, please?
Sure. My name is Chris Bauer. My business address is 400 South Tryon Street, Charlotte, North Carolina.
And who do you work for, Mr. Bauer?
Duke Energy Business Services.
Okay. And what's your title?
I'm the Director of Corporate Finance and the Assistant Treasurer.
All right. And you are the same Chris Bauer that pre-filed direct testimony in this proceeding on April 1st of this year, consisting of 15 pages and exhibits CRB 1 and 2. Is that correct?
I am.
And you're also the Chris Bauer that filed rebuttal testimony on July 26th of this year, consisting of 10 pages. Is that correct?
That's correct.
You have any corrections to that pre-filed testimony?
No, I do not.
Okay. Madam Chair, Piedmont would move that Mr. Bauer's direct testimony and rebuttal testimony be entered into the record as if given orally from the stand.
Mr. Bauer's pre-filed direct testimony and pre-filed rebuttal testimony will be read into the record as if given orally from the stand.
And we'd also ask that Mr. Bauer's exhibits CRB 1 and CRB 2 that were attached to his direct testimony be marked as identified and entered into the record as a composite hearing exhibit.
Mr. Bauer's pre-filed direct exhibits DRB1 and DRB2 will be marked for identification as hearing exhibit 10 and entered into the record of this case.
Thank you, Madam Chair. Mr. Bowers, have you prepared a summary of your testimonies?
I did.
Could you provide this to the commission, please?
I sure will. My name is Chris Bauer. I'm the Director of Corporate Finance and Assistant Treasurer for Duke Energy Business Services, LLC. DEBS provides various administrative and other services to Piedmont Natural Gas Company, Inc., or Piedmont. I pre-filed direct testimony in this docket on April 1st, 2022, in support of Piedmont's application for a general rate increase. On July 26, 2022, I submitted pre-filed rebuttal testimony in this proceeding. My pre-filed direct testimony addresses Piedmont's financial objectives, capital structure, and cost of capital. I also discuss Piedmont's current credit ratings and forecasted capital needs. My testimony emphasizes the importance of Piedmont's ongoing ability to meet its financial objectives and the benefits to customers resulting from Piedmont maintaining financial stability and strong credit ratings. My pre-filed direct testimony is accompanied by 2 exhibits. One is the capitalization schedule, and 2, the embedded cost of long-term debt projected for March 31st, 2022. I submitted pre-filed rebuttal testimony in this docket on July 26, 2022, in response to specific portions of testimony of South Carolina Department of Consumer Affairs witness Rothschild and Office of Regulatory Staff witness Baudino. My rebuttal testimony provides the basis for my recommended capital structure and addresses witness Rothschild's capital structure recommendations and his recommended return on equity. My rebuttal testimony also addresses the potential financial impacts to Piedmont if the Commission were to adopt Mr. Rothschild's recommendations. This concludes the summary of my pre-filed direct testimony and rebuttal testimony.
Thank you, Mr. Bauer. Madam Chair, Mr. Bauer is available for cross-examination. Questions by the Commission?
Thank you, Mr. Jeffries. And Mr. Elliott?
No questions. Thank you, ma'am.
Mr. Hall?
I'm good, thank you.
I'll try to make sure I'll lean over for everybody. Mr. Bauer, I see you do, looks like you have a copy of your testimony there.
I do.
Okay, great. Like I've told everybody else, if I need to slow down and let you get to your testimony, please let me know. I think you just covered it. You are employed by Duke Energy Business Services as Director of Corporate Finance, right?
That's correct.
And in 2017, you were in Duke's Treasury Department and served as both a Treasury Director and Director of Credit and Capital Markets.
That's correct.
I believe on pages 1 to 2 of your direct, it states you are, quote, responsible for financing the operations of Duke Energy and its subsidiary utilities such as Piedmont. This includes the issuance of new debt and equity securities and obtaining other sources of external funds.
That's correct.
Have you and the companies been successful in obtaining funding?
Say that again, I'm sorry.
Have you and the companies been successful in obtaining funding?
I believe so.
And Duke has been successful in obtaining the funding it needs?
Yes.
Regarding the capital structure, in your rebuttal testimony on pages 1 and 2, you state, my recommendation to follow the consistent Rate Stabilization Act practice of using the actual capital structure as of March 31st to establish new rates. Does that sound right?
Yes, it does.
You would agree this is not an RSA proceeding, correct?
I agree with that.
And you are aware that in order to ensure fair and just rates, the Commission often uses hypothetical capital structures?
I'm aware.
In your rebuttal on page 2, you state, I also took into account the fact that Piedmont has elected to continue the RSA mechanism following this rate case. As such, the selection of a capital structure in this case is effectively for a 1-year period, which further supports the use of Piedmont's actual capital structure consistent with prior RSA dockets. Does that sound right?
That sounds right.
Why do you think the capital structure is effective for only 1 year?
In this case, we would come back to file an RSA as I would understand it, and the capital structure would be reviewed again at that time.
Okay, I'm going to show you, well, first, I'll show you what I put up at the end of the day yesterday. And this is, can you see that okay, or should I enlarge it?
I can see it, thank you.
Okay. So this is from the RSA statute. And as I read yesterday, it says, in carrying out the procedures established by this article, with respect to such an election, the Commission shall rely upon and utilize the approved rates, charges, revenues, expenses, capital structure, returns, and other matters established in the Public Utilities most recent general rate case proceeding. Is that correct reading?
Yes.
So would you agree this part of the statute at least implies that the PSC has to use the capital structure and ROE from this case in future RSAs?
I would agree with that.
Okay. And I will concede, as Mr. Huber showed yesterday, that the settlement entered by the parties and it is a provision that the DCA has signed on, states that all the parties to the settlement, including DCA, agree that that capital structure may be adjusted, but not for that settlement. You agree that the statute, again, seems to at least imply that the capital structure would stay the same even in an RSA case.
I would agree with that.
I've got a, sorry, I'm going to skip some of these questions. I guess, well, I think it's been discussed enough, but we can establish that you did not do any specific analysis on the impacts of the capital structure on Piedmont's credit ratings. Is that right?
I did not do a specific analysis. What I can do and what I can offer here to the Commission is when I think about the capital structure of the company, I think about the actual capital structure of the company, not a theoretical capital structure. I view capital structure different than ROE. I think that ROE, in my opinion, is subjective. I think that there are a lot of models. We've heard a lot over the last day and a half of how ROEs can be calculated and how they can be applied from the discretion of the Commission to find what's fair and reasonable. To me, the way that I work in the corporate treasury function is that I take the capital structure that's provided by the Commission and I implement it. That is how I actually capitalize the company. Not theoretically, that is exactly how I capitalize the company. Now, capital structure changes from day to day with the timing of cash payments, with the timing of capital market transactions, dividends to and from the parent company, the capital markets, or the capital structure does move around. But I think about the capital structure as the actual capital structure. That's why I stayed there. And the reason being is I interact, unfortunately, weekly with the credit rating agencies. Because we operate such a large company and we have utilities across various jurisdictions and a holding company, there are a myriad of issues that we talk about on a weekly basis. And unfortunately, sometimes I'll talk to them on a daily basis. And so I do not represent Moody's Investor Services. I do not represent S&P in this discussion. But what I can say is I have a lot of dialogue with them. I understand what it takes to maintain ratings. And the A3 rating provided by Moody's and the BBB plus rating by S&P are incredibly important to Piedmont Natural Gas. And so when I think overall about the amount of cash flow that's generated by this company to support the obligations that we have, the fixed income obligations that we have, and I think about the level of debt that we have on our balance sheet, I think that our actual capitalization structure today supports that A3 rating. Any derivation from that could cause some issues with the rating. I know that that's also been thrown out a couple times over the last day and a half that maybe the rating agencies could respond, maybe they won't. I can tell you, and I'm ready to walk through examples of exactly how the credit rating agencies establish that A3 rating and what it takes as a company to defend that A3 rating. So I would say the premise of my testimony is really on maintaining the credit quality. That's one of the financial objectives of Piedmont Natural Gas, is to maintain credit quality, a strong balance sheet. And what does that do for us? It provides access to capital through all market conditions at reasonable rates of return on behalf of our customers. That's what we focus on. So that's the premise of my recommended capital structure, was the actual capitalization structure.
And you stated there, and you said it in the same discovery responses to the department, that maintaining a capital structure consistent with the current allowed capital structure was your objective.
That was my objective.
And that has allowed the company to sustain the current BB plus A3 rating.
That's correct.
And again, the current authorized capital structure is 52.2% equity.
That's correct.
And that has allowed the company to maintain its credit rating.
That's correct. That is the capitalization structure at Piedmont, South Carolina. There's a capitalization structure in North Carolina and in Tennessee as well. We don't issue securities, and there's no different ratings between the different states. It's one company. And so in this instance, it was so important to me to maintain the A3 rating that I did take a little bit of leverage off the balance sheet in order to maintain that rating. And that comes from direct conversations with the rating agencies. It's well written in their in Moody's recent credit opinion that we're weak for our rating. So to hang on to that A3 rating, I'm already weak. Any additional leverage or any reduction in operating cash flows would cause that rating to be under pressure. So that's why you see from the last time we filed our RSA filing and we were closer to 52.5% common equity, that common equity percentage has gone up because the amount of debt on the balance sheet has actually come down just a little bit. And so like I said before, I try to operate the capital structure within a relevant range of the signal that the commission sends. When they say we want 50-50, I try to operate as close to 50-50 as I can. But it's also important in different economic climates to maintain that credit quality, to provide that access to capital at reasonable rates.
I understand. Do you know if the company's credit was downgraded, what the cost of debt would be?
That's a really hard question to answer. And I would say that it depends. I'm an MBA as well, and that seems to be that's how you learn to answer a lot of questions. But it depends on market conditions. I'm in the capital markets often because we issue debt on behalf of all of the operating utilities as well as Duke Energy Corporation. It's my job to stay very close to all of our peers and how they issue debt. And so I look at credit ratings and I look at the rate of interest that's charged for their securities. And I can tell you that there is a difference. Over the past couple of years, understand, and we've talked about where the economy's been and where the economy is going. I won't rehash any of that, but I will say that U.S. Treasury yields have been very low for the past couple of years. And likewise, the credit spreads on top of those have also been compressed. They've been very low. So in periods over the past couple of years, one could argue that what's really the difference between an A3 and a Baa1 at Moody's? I would say over the past few years, 10 basis points, 25 basis points, maybe somewhere for regulated utility in that ballpark. As credit spreads have doubled over the last 6 months, the widening has occurred also between ratings. And so now today, the difference between an A3 and a Baa1 at Moody's could be 50 basis points. It could be 60 basis points on any given day. Right.
So to make, and I'm sorry to interrupt, just make sure I understand basis points conversations. That would be saying going from the 4.08 to a 4.58.
So
right?
there are 100 basis points in 1%.
So that.
Yeah. So when I say 50 basis points, what I'm saying is 0.5%.
Okay.
And, you know, when we think about utility debt, you know, when we issue hundreds of millions of dollars for 30 years, 50 basis points is real money. That's a lot of money.
Do you disagree? Well, first of all, were you in the room earlier when I was doing some redirect with Mr. Rothschild and trying to walk through an example of showing how the overall rate of return
Yes.
can stay the same? Did you disagree with any of those numbers, assuming the 50-50 capital
It's math.
structure? Right. In your rebuttal testimony on page 4, line 5, you state that your recommended capital structure was not intended to result in the lowest overall cost of capital. Is that right?
That's correct.
Okay. Are you saying that there is a capital structure that would lead to a lower cost of capital, but you chose not to use it?
No, I think it's a math exercise. I think if the capital structure was 100% debt, that's very theoretical. That could never happen in practice. But if it was all debt and no equity, that would lead to the lowest cost of capital. So what we're trying to find here is balance, right? What is the right credit rating for Piedmont Natural Gas to access the capital markets on reasonable terms? Now solve for that. So we try to say, is a BAA okay, Baa1 okay, Baa2 okay? What about a crossover credit at Baa3 where I'm one notch away from high yield or junk bonds? Is that the right place for Piedmont Natural Gas? So in my opinion, the A3 rating provides access to capital markets in all conditions, and I believe it provides a very fair rate of interest that we can pass through to our customers. I think that 4.08% cost of debt that we filed in this rate case is premised on that A3 rating. I think if you move that rating down, that 4.08% goes up. And that's not being contemplated in this rate case. We're not talking about the cost of debt, but it's a real number, and that's a real number that gets passed through to customers. We think about that every day.
I understand. Are you saying that with a lower credit rating or a lower equity ratio that the company would not be able to raise money?
I think that we would be, I think that we are still a strong investment grade credit rating at A3. But if you think about investment grade ratings, there's 12 of them, right? So there's 9 A ratings. There's AAA, AA, single A, 1, 2, 3 at Moody's, and then, or at S&P, and then there's the high triple Bs. Once you move below those 12 ratings, you're in non-investment grade land. So when you think about where we are from all of those 12 ratings, we're 4 notches from the bottom. Okay. And I think that's sometimes hard when people don't talk about credit ratings all the time. You think about, well, an A3 or a Baa1, what's the difference? And I'm saying you're moving closer and closer to the very bottom of investment grade utility paper. You move too close to non-investment grade paper, and then all of a sudden your access to capital absolutely dries up. I think there are fewer market participants that show up to buy your bonds, and I think that the rate of interest that you have to pay is much higher. And so to me, striking the right balance, that A3 rating through the past couple of years as we've weathered these different economic cycles has been a very good rating.
I understand. And you may have just addressed this, and I'll show my little bit of ignorance on the issue, but why doesn't Piedmont arrange its finances to have a AAA credit rating?
That would be a AAA credit would likely be something with very low debt and mostly equity financed. That's also not striking the right balance for the right cost of capital for our customers. The purpose, you know, the thing is when you think about all the different industries that are out there in our economy, You know, when you think about the leverage that these different companies can carry, regulated utilities carry more leverage than any other industry. Why? Because they're regulated. You know, that's the purpose. There's so much stability provided by the commission over the long-term financial health of the company. It lowers the business risk profile so much that the agencies and fixed income investors allow the company to carry, you know, roughly 50% debt, give or take a few hundred basis points.
Do the credit rating agencies understand that concept about?
Oh, I mean, it's in their stated methodology. That's the reason why.
So you stated earlier, Duke has been successful. Duke has obtained the funds it needs. Do you know Duke's common equity ratio?
Duke at the parent company?
Yes.
So Duke Energy Corporation?
Yes.
The unregulated entity?
Yes.
The capitalization structure, we review it on a quarterly basis because we have covenants under our master credit facility. And I think that it's probably approaching 60% debt.
Okay. So 40% equity, much lower than the numbers we're talking about here.
That's right.
And they're able to raise capital. Do you know what their credit rating is?
Yes, it's Baa2 at Moody's and BBB flat at S&P.
And those are lower than Piedmont's, right?
Yes.
And no problem raising money?
No problem raising money, but we raise capital at a much higher rate of interest than we do at Piedmont.
You talked about some of the weaknesses that the credit reports note about Piedmont being a regulated utility.
Yes.
Are you aware that Moody's lists as one of their strengths is that its position as part of the Duke corporate family?
Yes.
Who raises equity capital for Piedmont?
Duke Energy Corporation. Well, Piedmont's equity comes from two sources, right? So it's internal, it's retained earnings. And so at the end of the day, we retain our earnings, and Piedmont has been retaining, as they've been part of the Duke family, I believe since 2016, I believe that they have retained all of their earnings from that period of time. It is the anticipation of Duke Energy, the holding company, that each of the utility subsidiaries dividend 70% of their earnings over the long run to satisfy the 70% dividend payout ratio at the corporate level. Piedmont has dividended nothing since 2016 to the parent company and has actually had some equity infusions from Duke Energy Corporation over the past few years.
Yeah, in fact, since 2018, they've received capital contributions from Duke totaling $775 million. Is that right?
That's right. Subject to check.
Just a minute, let me make sure I've got something to put on the screen for you here. Are you aware of the companies in Mr. Coyne's proxy group and their capital equity to debt ratios?
I'm not that familiar.
Okay. Let me see if I can find them for you. Okay, sorry, too many papers up here. I'm going to try to get them all on the screen here, but I can certainly zoom in. Just want to show that what we're looking at. This is actually Exhibit ALR 5, page 5 from Mr. Rothschild's testimony, showing the six proxy groups, and I'll submit to you that the column 5 there are their equity ratios from 2021. Can you see those?
I can.
Okay. And do you agree that 5 of the 6 of those are under 50%?
Yes.
And let's see, at least 2 are under 40%?
Yes. I'm not certain I'm not as familiar with that proxy group. And I'm not sure if that's an operating company level or if that is a holding company level.
I will submit, I believe these are the holding company level.
Okay. So okay. let you continue, but my initial response there is that I wouldn't compare a holding company to an operating company. It's a regulated versus a non-regulated entity.
I understand it, and that's been at least a little bit of discussion and testimony. But equity is raised at the holding company level, correct?
It is.
And the ROE analysis is done at the holding company level, correct?
An ROE analysis, we do not do an ROE analysis at our holding company. It's non-regulated.
Do you know at what which level Mr. Coyne used in his analysis?
I'm not familiar, no.
Okay. Would you dispute that he did that analysis at the holding company level?
I don't want to speak for Mr. Coyne.
Now I'm going to show you. You can't quite see it on the top corner, but this is Exhibit JMC3 from Mr. Coyne's direct testimony. Do you see that all the proxy group companies have at least a BBB plus credit rating?
I do see that.
And I don't know if you can see the two that say NA. It does note that New Jersey Natural Gas is rated A1 by Moody's, and Northwest Natural Gas is rated A+ by S&P and Baa1 by Moody's. And again, these are, so we just looked at the capital structures, and we have, you know, low equity percentages, and yet they still have good credit ratings. Is that right?
You know, we don't talk about, and neither do the rating agencies talk about an equity percentage at our holding company. And so if you were to read a Duke Energy Corporation credit opinion, it would not talk about an equity percentage because there is not one awarded. What the rating agencies look at when they rate Duke Energy is two financial metrics. The equity percentage is not one of those. The two financial metrics are holding company debt to total debt. And so that's of the entire consolidated debt portfolio, how much holding company debt is there compared to all of the debt. For us, they give us a bogey of 35%. So long as we don't go above 35%, we're able to maintain our Baa2 rating at Moody's. S&P has a similar approach, and they put the same guardrails in place as well. But there's also an FFO to debt, which is a very important credit metric. And at Duke Energy Corporation, Moody's has ascribed a downgrade threshold of 13% FFO to debt and a 12% FFO to debt downgrade threshold by S&P. Those are the two metrics that help us hold our current ratings at Duke Energy Corporation.
It may just be a coincidence that some of the numbers you mentioned were similar, but what is Piedmont's debt to capital covenant with its bondholders?
I believe it is not to exceed 70%.
And that means basically that Piedmont is not legally allowed to have an equity below 30%.
Correct.
So pretty far away from the 45 to 53 we're talking about as far as obligations to bondholders.
Right.
In your rebuttal testimony on page 2, lines 14 to 20, you criticize Mr. Rothschild's recommendations, and you state that his structure of 44.58% equity and debt, or in 55.42% debt, is based solely on an average of a selected proxy group of companies geographically dispersed across the country with various credit and business risk profiles. You go on to say you do not find it to be reasonable, and in the last part of that sentence, nor representative of a reasonable and appropriate equity level at which to fund the safe and reliable utility operations of the company. Is that right?
Yeah.
And you're aware that company's witness Coyne is the one that chose this proxy group. The proxy group that Mr. Rothschild used is the same one that Mr. Coyne used.
Okay, probably more for an ROE analysis and not a capitalization or cap structure analysis.
I understand. I just want to show you a little bit about what Mr. Coyne at least thought about the proxy group in relation to your statement about them not being regionally representative of Piedmont.
So here on his direct, on page 24, lines 3 to 5, he states the proxy companies used in my ROE analysis possess a set of business and operating characteristics similar to Piedmont natural gas utility operations and thus provide a reasonable basis for estimating the ROE. Again, I understand the distinction, but we at least agree that Mr. Coyne thought the proxy group possessed a similar set of characteristics.
I would agree that Mr. Coyne thought that this was a reasonable basis for estimating the company's ROE, not capital structure.
And so you disagree with using the same, just to make sure I understand your point, you disagree with using the same proxy group to estimate capital structure.
I think in the issue with trying to use a proxy group is what I'm trying to say in my testimony is that our actual capitalization supports an A3 credit rating. And I don't want to lose sight of that. And I'll repeat it again. So I don't know the credit ratings of some of these other companies. I don't know the operating characteristics of those of those companies. But what I can say is that the capitalization structure that we have, the level of debt that we have on our balance sheet, the operating cash flows that Piedmont generates, produces a credit rating of A3. What I'm defending is that A3 credit rating.
I understand, but I'll tell you why I've got to walk through this analysis. And that's because we've heard discussion of Hope and Bluefield. Mm-hmm. And are you familiar with those Supreme Court cases?
Over the last day and a half, I have become.
Okay. Well, essentially what they say is that the utilities is entitled to an opportunity to earn a return commensurate with returns being earned by similar companies' risks. And as we discussed a little bit earlier, the rate of return is a combination, includes capital structure, cost of debt. And so they cannot be separated in the commission's in the commission's determination of a fair and reasonable rate. So do you at least understand the use of proxy companies for both ROE and capital structure in that context? So I want to continue with Mr. Coyne's direct testimony here, page 25. He discusses his various criteria for selecting this group. And again, one of them is that they maintain an investment grade long-term issuer rating of at least BB minus or higher from S&P. You see that?
Yes.
And finally here, Mr. Coyne on page 26 states that he has selected this group to best align with the financial and operational characteristics of Piedmont. The proxy group screening criterion requiring an investment grade rating ensures that the proxy groups like Piedmont are in sound financial condition. Did you see that?
Yes.
So I've heard what you've said about maintaining the credit ratings, but your testimony on your rebuttal, page 3, says that my rebuttal testimony also examines the probable detrimental impacts to the company of Mr. Rothschild's 7.86% ROE.
Yes.
And Mr. Rothschild also recommended a range of 6.98 to 8.74. Understand that, correct?
Yes.
Do you also believe that the 8.74 would have probable detrimental impacts to the company?
I do believe so.
Have you heard the discussion throughout this case about the ability of ComEd to raise $750 million of first mortgage bonds with a 7.36 ROE and a capital structure of 48.7% equity?
Yes.
And are you aware of the Kiowa Island case that's also been discussed in which it settled for 8.69?
Yes.
So I have to ask you, do you agree a company would not accept an 8.69 ROE if they thought it would be detrimental to their ability to raise capital?
Well, I would say the word detrimental is a bit overstated. Would that level of ROE send a shockwave through not only the investment community, but through the credit rating agencies? Yes. Does that get away from consistent, predictable rate making in the state of South Carolina? Yes. Would that cause them to then go before a credit committee and reevaluate the business risk in South Carolina? Yes. Would that change my downgrade threshold? Yes. Could that then impact my credit rating? Yes. So I think that sends a signal, right? And so what I would do, and we can do this now or later, but, I think it's important to understand because Moody's speaks on behalf of fixed income investors, right? And so when they evaluate a credit rating, they do so using qualitative and quantitative metrics. It's an easy analysis to think about. It's a stated methodology, but what they think about, the first 25% is the regulatory framework. That's what they consider. So before they even look at the balance sheet and the cash flow statement of a company, they look at the regulatory framework. And so what does that mean? It's the legislative and judicial underpinnings of the regulatory framework and the consistency and predictability of regulation. And so when they think about Piedmont Natural Gas, they think about things like the RSA, that's credit positive. They say it in their credit opinion. They think about weather normalization. They think about consistent regulation that's occurred in this state for many years. All of that goes into their business risk profile. Once they build that out, the next factor is the ability to recover costs and earn returns. It's stated in their methodology. And that breaks down to timeliness of recovery of operating cash, so the timeliness of recovery of operating and capital costs and sufficiency of rates and returns. And so they also think, so the first 50% before they even look at the financials of a company is they're trying to understand how consistent, how predictable is the regulatory environment that surrounds a regulated utility. Because like I said, they allow for more leverage in this business model because of the longstanding nature of the regulation in the state in which they operate. That allows us to carry the amount of leverage necessary to keep that weighted average cost of capital low for customers, right? And so that's the first thing that they do. The next thing they do is then say 10% of our analysis thinks about diversification. Well, that's great for Piedmont. We operate in South Carolina, North Carolina, Tennessee. So we've got jurisdictional diversification. We don't serve just one customer. We have residential customers, commercial and industrial customers. So no customer concentration. And so credit positive, that's great. Then you go to the financials and they have one credit metric. There's many in here that they cite. There's 4, but I'll tell you, in my experience over the past 5 years, they focus on one metric, FFO to debt. So
can I stop you just to
Sure.
ask one thing? I'm sorry, I'll let you finish. But so you're saying they list 4, but they only use 1?
They list 4, and those are CFO pre-working capital plus interest divided by interest over a 3-year average. We don't ever talk about that one. CFO pre-working capital to debt, that's the one that I just talked about. I'll simplify it to just call it FFO to debt, funds from operations. There's a couple more iterations of CFO pre-working capital minus dividends to debt and debt capitalization. When you look at the front page of a Moody's credit opinion, they actually graph FFO to debt on the very front page. This is prominent for them. So that is the credit metric. They look at a lot of them, but the FFO to debt metric is the one that they focus on the most. And so when we think about how that comes together, it's a mathematical formula. They go to the top section of the cash flow statement and they say, how much organic cash flow does this company produce? And the denominator is total debt. And it comes up with a number. And so for us, our downgrade threshold based on consistent, predictable regulations, supportive legislation in the state, a positive business risk profile, they give us a downgrade threshold of 14%. They say as so long as your FFO to debt is north of 14%, you get to maintain your A3 rating. If it drops below that, you will suffer a downgrade. We just suffered a downgrade at Duke Energy Corporation. I went through that process. It's real. And it was focused on the business risk didn't change at Duke Energy Corporation. It's the fact that we couldn't maintain the FFO to debt on sides. And so they will downgrade you if you don't maintain your 14% FFO to debt. So then one would say, well, where have you been? Where are you? And I would say, well, in 2020, we were at 13.5%. You would say, well, that's below your downgrade threshold. It was also the COVID year. It was a very interesting year for a lot of businesses, but it was a year in which we were short on cash flows. Debt is fairly constant in our capitalization structure. And so we worked with the agencies. They gave us 1 year to get our head above water, and we did. In 2021, we delivered an FFO to debt of 15%. But if you go into their credit opinion, there's other, words that they say in here, and, there's credit strengths, there's credit challenges. In the credit challenges, it says stable credit metrics, but weak for its A3 rating. When you flip the page and it says factors that could lead to a downgrade, It says, there could also be downward pressure on the company's ratings if we expect CFO pre-working capital to debt ratio to be below 14% for an extended period of time. So I read those signals and I have conversations with the agencies that say, listen, we're not kidding, 14%, that's all you get. You fall below it, your rating drops. So when I looked at Witness Rothschild's recommendation, forget the proxy group and just take his recommendation and say, flip my capital structure. Because right now I'm 54.5% equity, and he wanted to flip that to 54.5% debt. And I did the math and said, okay, well, what's the difference? If I actually capitalize the company the way that he describes, I would have to add $600 million of debt to the balance sheet of Piedmont. That's what I would do. It's not theoretical. This is not an ROE that could be this number or that number. The capitalization structure is a real number. And so when you put your hand on that lever, that is exactly how I'm going to capitalize the business. So if I were to add $600 million of debt, and I went back to this FFO to debt computation, and I just simply said, okay, ignore the numerator because I don't know what the rest of the rate case outcome will be, and I don't know how the revenues would be impacted. But I do know that I would recapitalize with $600 million of additional debt, put that in the denominator. The number that I would go from, 15%, would drop to something like 12.5%. That's indicative of something more like a Baa2 rating. That's not a one-notch downgrade. That's likely a two-notch downgrade. Now I'm one notch away from crossover credit, meaning one more notch below that, and I'm in junk status. And I'm issuing bonds that are called high yield for a reason. It's very expensive debt. And that's a place that as a utility, we're conservative by nature. That's not a place that we want to go. The consequences to our mistakes that we make are very consequential. And so, yes, sometimes we are conservative, right? And we do sometimes think in terms of, could the sky fall? I've heard witnesses say that. These utility guys get up here and they talk about, the doomsday scenario, but it's true. And I'll give you examples. There were two, rated companies. One was a peer of ours called Appalachian Power that tried to come to market in 2020, right after COVID came. They were seeking additional liquidity because nobody knew what COVID was going to do to their business model. They couldn't place capital. They're one notch below us at Baa1. Entergy came the same week and tried to get capital. This is a Louisiana utility. So Entergy came to market, I think, just the week before App Power. They're a Baa2 rated company. They couldn't get any capital. They had to pull their deal. So the access to capital is real. And we talk about storm costs, but there were also, disruptions in the economy like COVID. And unforeseen circumstances do occur. And we make investments in critical infrastructure, and we make investments over a very long period of time, and we need consistent access. And so I don't think that the A3 rating that we're trying to defend is exorbitant. I'm not trying to defend a AAA rating. This is a single A, the very lowest of the A rating category. If I get downgraded now, I'm Baa1. I'm 3 notches away from junk status. If I were to drop to 12.5%, as Mr. Rothschild's capital structure would likely do, I would drop to 12.5%. That could be a 2-notch downgrade. Now I'm 1 notch away from junk status. That's not where we want to operate this company. I think having a highly rated or even in just an A-rated utility in the state of South Carolina is an asset for the customers. I do think that it provides the premise for that 4.08% cost of debt that we have. Absent that A3 rating, that 4.08% could be something like 5% or higher.
And I appreciate the examples that you provided of, people's difficulty. There was a lot of discussion about being able to do an analysis, this cost-benefit analysis, particularly to the impacts on customers. It sounds like that's something you could do. Am I mistaken?
I think that you could do it if you knew what the cost of debt was. So what's the cost of a downgrade? What's the cost of 2 downgrades?
That's the magic question.
That's the magic question.
Right?
And so if I were to do that analysis, I think we'd sit up here for a day trying to determine, is it 20 basis points, 50 basis points, 100 basis points? Is it a 1-notch downgrade? Is it a 2-notch downgrade? I don't know. But a 200 basis point reduction in ROE, I think sends a very clear signal to the rating agencies and to the investment community that the climate in South Carolina has changed.
I can't say I agree or disagree, but we were talking about real money for the company. You agree that these make a real difference for customers too. If it was a downgrade and was a slightly higher cost of debt, that could still be a benefit to consumers. You understand how that can happen, right?
I think that it would, but I think it's a little short-sighted. I think that you would look at it and you'd say, in a math exercise today, when we look at that today, and you then again assume that take the downgrade, save customers a few dollars today, take another downgrade and save them a little bit more money. There comes a point when that could come back and that could bite, and that could be a bad day when you need capital and you can't get it. Or you need capital and there's very few market participants and you have to pay very high rates of interest.
And I think that's what, at least maybe Commissioner Irvin was kind of hoping to find out, right? Where is that sweet spot? Would you agree with that? And even if it took a day, that might be beneficial to the commission?
Again, I think, to the commissioner's question, I think at the end of the day for me, it's what is the right rating for the company? And design a capital structure that supports that rating. That's what I would argue.
And just, again, the company has maintained its rating with a current 52.2% equity, right?
Yes.
That's all I have. Appreciate your time.
Appreciate it.
Thank you, Mr. Hall. We've been going about an hour, 50 minutes, so why don't we take a 10-minute break and we'll be back at about 4:01. Welcome back to the Public Service Commission of South Carolina for continuation of the rate case of Piedmont Natural Gas in docket 2022-89-G. Let's take a roll call of commissioners. Present virtually, we have Commissioner Irvin, and present in the hearing room, we have Commissioner Justin Williams, Vice Chair Powers, Commissioner Thomas, Commissioner Carol Lee Williams, Commissioner Caston, and Chair Belser. We just finished with DCA cross-examination of Mr. Bauer. Mr. Huber?
No questions. For
I'm out of order. I apologize. Mr. Elliott?
No questions. Thank you, Madam Chair.
Redirect? Oh, wait a minute. Let's go to commissioners first. I apologize. Commissioners.
Madam Chair,
Commissioner Irvin.
thank you. I'd like to cut straight to the chase. You've established, based on your testimony in this case, that you deal with the Moody's and other rate makers on a daily basis. Is that correct?
Yes, sir.
And so you're the person that has to understand their methodology, their metrics, and their requirements to maintain your current credit rating. Is that correct?
Yes, sir.
There's nobody else in the world that could tell us more about that than you. Is that true?
Maybe in the room.
Thank you. You're humble. So if we, as a commission, decide to adopt witness Rothschild's recommendations as it relates to capital structure and ROE, how is that going to affect your conversation when you get a call from Moody's asking you to explain what happened?
I think that would be a very tough discussion with Moody's. They would ask a lot of very pointed questions about the commission. They would want to know, from my perspective, how the commission arrived at that decision. But ultimately, a commission decision is their decision. And so we would implement the commission's order, and the resulting financials would show up as I recapitalize the company. I would put more leverage on the company's balance sheet. The financial credit metrics would decline, and the rating agencies would move to take rating action if they felt that was necessary.
And based on your experience in the industry, and how many years have you been in this current position?
My current position, about 4 years in total in Treasury.
All right. And with the company?
12 years, sir.
All right. Based on your 4 years of experience in this position, what is your expectation and anticipation? Let's just assume, for the purposes of our questioning, that we chose to adopt Mr. Rothschild's recommendations. What would you expect the credit agencies to do if we implemented that by way of an order and you had to make the adjustments as you described?
I think the very first thing that they would do is they would read the order. They would reassess the business risk of the company. If they feel that they do not believe that we have the ability to recover costs and earn returns that are commensurate with those of our peers, then they would notch us down for that rating category. After that, we would put more leverage on the balance sheet than they would have allowed us to maintain our A3 rating. And so that would likely lead to a credit committee meeting, probably within a matter of weeks, and they would take rating action, I think, almost immediately. I think that a one-notch downgrade would be my best case scenario for an immediate action, because I think our business risk profile would change. What that means, sir, is that when your business risk profile changes, that 14% FFO downgrade threshold that I described before would immediately move up. If your business risk goes higher, then they would expect you to generate more cash flow to service the debt that you currently have. That's before I recapitalize the company. So our downgrade threshold would move from 14 to something higher. Maybe it's 16, maybe it's 17. As I indicated before, we're currently at around 15%. That means that we are already below the newly established downgrade threshold that would lead to the first downgrade immediately. Then they would wait, and as I recapitalize the business, I wouldn't go issue $600 million in one day. I would grow into that over a period of time, a short period of time. But as I do that and the financial results of the company continue to decline with that additional leverage and the lower cash flows, because we have now a lower ROE as well, then I think that you could reasonably expect that another downgrade could happen.
So what you've described is, in lay terms, is a slippery slope. Is that correct?
Yes, sir.
And as you go down that slippery slope, the cost of capital for Piedmont Natural Gas goes up exponentially, correct?
Without a doubt.
And that gets passed on to customers, does it not?
Immediately.
And let's just think of this hypothetical for a moment. Let's say that the state of South Carolina is experiencing and has recently experienced an increase in seismic activity. And things worsen to the point that we have a catastrophic earthquake that disrupts and tears up your company's infrastructure. And you're now downgraded by Moody's and others, maybe one, maybe two notches. And now you've got to go out while hundreds of thousands of residents are without power and without gas. And industry in South Carolina comes to a standstill. And hospitals are running on generators. Can you raise the necessary capital to fix that?
So here's what I would say about the credit ratings and why it's so important under a scenario that you just described. We've talked about, and I've heard ComEd talked about now 4 or 5 times, that they had the ability to go raise capital at this ridiculously low ROE and capital structure, but they still had access to capital. They issue secured debt. And so what that means is under their first mortgage, they secure the assets of the company. And so there's collateral on that debt. And so fixed income investors would still go buy that debt because if something were to go wrong and the company claimed bankruptcy, there's a security that they have. They have collateral to their debt. Piedmont Natural Gas does not have a mortgage. And so we issue debt on the promise of our balance sheet. So we issue debt off of our credit rating. That's why that credit rating is so important, because we don't issue secured debt. We issue off a promise. If that credit rating were to dissolve and move down to Baa1 or Baa2, it gets much harder to try to attract capital. Now, on top of that, you put something catastrophic as what you just described, and I think now you become an absolute taker in terms of price. Could you access capital? In the grand scheme of things, Piedmont is a part of a bigger family. And so I think that there is some security to investors there, but at what cost would be my question. What would be the cost of that capital? I think it would be very, very high. And I think that there would be fewer people showing up to loan that money to you. And so I think you lose a lot of financial flexibility. I think you lose a lot of financial leverage. And because of that, I think you pay very high rates of interest.
And that has to be passed on to customers, correct?
Yes, sir.
And it would be passed on in the next, as soon as possible, because the company needs that.
Yes, sir.
As soon as you could file a rate case increase, you'd have to do it, wouldn't you?
Yes, sir.
And so if the credit rating is, and let me just talk about historical fact for a minute, because I always think that hindsight's 20/20. This commission has always taken a conservative view when it comes to capital structure. And that can be borne out if you look back over the last 40 years, the decision making. That's always been an important metric. And if you lose that, it's a game changer, is it not?
It is.
And it doesn't just affect Piedmont, because the rating agencies are always also looking at all other regulated investor-owned utilities in our state, because they're all coming to the same commission, right?
Correct.
And so if you get downgraded, and this, as you likely would, what impact will that have on Duke Energy? Duke Carolinas, How would that impact your parent utility?
It would put pressure on many of our issuers. It would put pressure on Duke Energy Progress. It would put pressure on Duke Energy Carolinas because they also operate in the state of South Carolina. And so let's go back and we'll talk for just a moment about that conversation that I think I would have with the rating agencies. They wouldn't limit the conversation to Piedmont because this is not the only utility that we operate in the state of South Carolina. So they may take a new change and that business risk profile would move forward to Duke Energy Carolinas. It would move forward to Duke Energy Progress. Potentially their business risk profile could change as well. It likely would. If it changed for Piedmont, it makes sense that it would change for the others. It's the same regulatory body. That downgrade threshold there could possibly move. We could suffer downgrades at those two utilities, all else equal. And then, those downgrades funnel up to the parent as well. And so lower operating cash flows that come to the parent as it consolidates puts pressure on the credit metric that we're trying to maintain, which what I said was 13% FFO to debt at Moody's and 12% at S&P. S&P has a very interesting methodology. They use a family rating methodology, which means they rate the parent and then all of the children, the subsidiaries, are notched off the parent. So if the parent's downgraded, every utility across our entire portfolio gets downgraded.
So it has an exponential effect.
Yes, sir.
And it wouldn't be limited just to Duke, would it? It would also spill over into Dominion and other utilities that are doing business in South Carolina, would it not?
Correct.
Because they're all coming to the same commission too.
Correct.
And the alarm bells have gone off. There's a change in Columbia, South Carolina. And there's no way to back that out. Once it happens, it's like ringing a bell, isn't it?
That's right.
You can't unring it.
That's right. And that's why even in these credit opinions, when they talk about, because they have to lay the groundwork for their decision, which in this case is an A3 rating, and they go through, the framework that I described before, and they talk about the historical nature, because that's what they have to look at. So they are eagerly anticipating watching orders come, not just in South Carolina, everywhere. They watch orders, and what they're looking for is a change in trend. Can we maintain that business risk profile the way that we have historically seen it? And so you use history, and in this case, they state it very accurately on the front page of the report that Piedmont has historically strong and supportive regulatory jurisdictions. And so they are looking, but they're also waiting and eagerly anticipating watching orders such as this one from Piedmont.
So the sky would be literally falling if this scenario played out and as I've described it.
From a ratings perspective, yes.
And it would take years, if not decades, to recover a higher credit rating because until the rating agencies saw more conservative established approach, they're not going to change their mind overnight, are they?
That's right. I mean, ratings are very sticky. And what I mean by that is that the rating agencies don't like to move a rating around very often. And so when they take action to downgrade a company, they typically make the upgrade threshold higher than where you were before. And so it's a higher hurdle just to get back to the rating that you once were. So taking a downgrade is nothing that should ever be taken lightly because it is very hard to get it back. And so, as I sit here today and I listen to the arguments in the room and the cost benefit analysis that's been talked about, can we save customers a few dollars here, and maybe take a downgrade or two, I would caution because that rating does not come back very often. Remember, investors in fixed income securities like bonds of utilities make investments for 30 years. What they don't want is they don't want that bond rating to change every 6 months or every 2 years. They want to put it away, they want to collect the coupon, and they want to forget about it. And so therefore, the rating agencies don't like to cause a lot of volatility in that market. And so they take very long views, they take very measured action, but they are very decisive and very quick when you don't meet their thresholds to maintain the rating. And like I said, the upgrade threshold is usually a very high hurdle to get it back.
It's a much higher bar.
Yes, sir.
You've been very helpful in helping us understand how all this works, and thank you. I have no further questions.
Thank you.
Thank you, Commissioner I'm not sure. Is that Vice Chair? I'm not sure whose light is on. Oh, Justin Williams. I'm sorry.
Thank you, Madam Chair. Good afternoon, sir. Thank you for being here with us.
Thank you.
I appreciate your testimony. It's very informative. I'm just trying to get a better understanding of the impact of our decision based on everything that we've heard. And it's a pretty serious consequence of, or set of consequences possible if we accept Mr. Rothschild's recommendations based on your opinion. Is that fair to say?
Yes, sir.
Okay. And you have discussions, I don't know how often, but you have discussions with the rating agencies, the credit agencies?
Very often.
Okay. When's the last time you had a discussion with them?
Last week.
Okay. And generally speaking, does South Carolina's regulatory environment come up?
It does from time to time in different contexts. This is a new commission. There's not a lot of orders that there are here. And so we get a lot of questions just around, what are the feelings down there? What are they like? This is my firsthand experience. And so they ask a lot of questions about that because they haven't been able to study enough orders. We think about different things, and this is not Piedmont specific, but the discussions that we have are around, different investments that we're making on the electric utility side in the state of North Carolina. It's a blended utility. And so how will that go in South Carolina? I'm always very quick in those discussions, sir, to say I do not speak on behalf of the commission, and I'm just like you. I'm, eagerly awaiting orders that I can read and interpret as well. And so I do think just for the fact that this body of commissioners is fairly new to them, they're inquisitive.
So they take no position on the current regulatory environment in South Carolina?
Where they do take, and they do state it very clearly here, is the legislative underpinnings and the way that the commission has implemented those, including the RSA, weather normalization, the ability to pass fuel costs through in a timely mechanism or a timely manner. Those are all very credit supportive. And so that's what they look to. And so that's why any change in legislation would change any changes in what they believe is the commission taking a different stance on what's fair in terms of a fair return. They do look, like I just explained to Commissioner Irvin, they do look over the very long run. And so history to them is very important. Any changes from that history and knee-jerk reactions and, what we're talking about here is Mr. Rothschild's testimony is hundreds of basis points of change in a far outlier from things like national averages. Moody's does the same thing. They use proxy groups, and I wouldn't call it that, but they look at all of the other LDCs in their rating universe, and they just compare them. And they say, how does Piedmont compare to those other utilities? If all of a sudden we became an outlier, I think that it would be a logical conclusion for them to say the business environment has changed, and we may need to reevaluate the business risk profile of Piedmont Natural Gas as it pertains to their South Carolina utility.
Okay, thank you for that. One of the things I like about your testimony is when it comes to the capital structure, it's not as subjective as ROE. You're dealing with real numbers.
That's right.
I like that. I like to deal with real numbers.
Me
I
too.
like to look at history or look at past decisions to see what happened and learn from those experiences. So I don't know if it matters or not, but since you're here and you're so, you have such a high level of expertise in this area, I'm wondering whether or not the commission's decisions in a Blue Granite water case and a PWR water case, where we adopted pretty low ROEs, whether or not that's had any impact on South Carolina's regulatory environment.
I think those are a couple of data points that did get attention.
Okay.
And I think that I'm not certain that, like I said, the rating agencies, they take a very holistic view. They take a broad view. I don't think that they're going to take those entities that are different than Piedmont Natural Gas, different from Duke Energy Carolinas and Progress in South Carolina, and draw a conclusion. That's why I say they eagerly await certain orders to say, okay, is this a general trend then in this commission?
So it wouldn't be fair to compare our decisions in water cases to Piedmont Natural Gas, this case?
No, I don't believe so.
Okay. One last line of questioning. You're aware of the argument that the consumer advocate's witness has made regarding utilities for a significant amount of time receiving overpayment. Were you here with witness Rothschild where he talked about overpayment?
I was.
Okay. What are your thoughts about that?
I disagree. I mean, it's, I think what you find is a fair return. And from my perspective, again, Commissioner Williams, is I deal with the output of these orders. I deal with the cash flow that's generated based on these proceedings. And so I look at the operating cash flows, I think about the leverage. And I do that to protect a balance sheet, as I've mentioned before, to give this company access to capital through all market conditions at reasonable rates. And so is there overpayment? I think it gets back to the fairness question, and I think that's discretion of the commission. I think that having an adequate capital structure, and this is where I was trying to communicate effectively, is the capital structure is real. It's not theoretical. It is, if you move it to 50-50, today it's 54.5%. If you move it to 50-50, I'm going to recapitalize the company to 50-50. That has real consequences. I'm going to add leverage to the balance sheet. If it goes, the stipulated agreement was 53.5, I'll probably leave it alone right where it is. Because like I said, we try to balance it within a reasonable bound. Capital structure moves every day. So when the timing of a large customer payment comes in, that's net income, which rolls to equity. That changes the equity component. When I go to market for Piedmont and I issue debt securities, in that moment, the very next day when I take possession of all of that cash, I have more debt on my balance sheet. So the capital structure moves throughout time. And so what I'm trying to do is over a long period of time, I usually look at about a year, we try to forecast where will the capital structure be at the end of the year at a specific point in time. We've been used at Piedmont to use March 31st. It's a process that we have internally to be able to find that number because we've used that number for the RSA. So as we put this rate case testimony together, it was very easy to look at where are we at March 31st. That was my starting point of my testimony was let's go there first. Where are we actually? And so as we forecast throughout the year, it's my expectation to try to stay within a very relevant range of what the commission's order is in terms of how would you like me to capitalize the company.
Speaking of ranges, the ROE experts gave a lot of testimony about ranges and particular points and the impact of each. In your opinion, is the stipulated capital structure a hard and fast number, or is there some movement there that wouldn't cause the doomsday scenario that's been discussed?
I think the stipulated amount, which I believe is just over 53%, I think that's reasonable. And I think that I could work down towards that over time, and I think that it would completely avoid the scenarios that we talked about.
Okay.
And from a capital structure perspective.
Understood. And I don't want to put words in your mouth, but you just stated and testified that you believe that's reasonable, 53.5%. That's the stipulated capital structure. Without having a calculator or doing whatever level of math you would need to do to determine other capital structures. I mean, are you prepared to give a bright line as to where we don't need to cross? 53.5. What about 52.5? What about 53? I mean,
well, I really don't think that that's that hard of math. I'm not sure I could do it in my head right here, but I think that you go back,
probably,
and that's why I tried to lay out how that FFO to debt metric, how it's used. And so if you look at it and you say, okay, the top portion of that metric is the operating cash flows. So pull that directly from the top of the cash flow statement, plug it in at the top. On the bottom, put in debt. So as you move the capital structure down, the equity component down, that means the debt component is rising. That's actual debt going into the denominator. At some point, you're going to cross that 14% downgrade threshold. Now, what I would also argue, and this comes across loud and clear with the rating agencies, we operate a company with a lot of uncertainty. We've talked about things like seismic activity that's starting to brew in South Carolina. We're all well aware that the Atlantic Basin heats up about this time of year every year. And so there are unforeseen things that we don't know. And so the agencies like us to carry a little bit of a cushion. They say, listen, that bright line, that 14% downgrade threshold really needs to be something bigger. They never tell you that it needs to be 14.5 or 15, but what they put in here is an expectation. And so their expectation for us to maintain the the A3 rating is that we maintain an FFO to debt ratio between 15 and 16%. So that tells you that the downgrade threshold is 14, but they'd like us to be somewhere between 15 and 16. That's the cushion that they're telling us we'd like you to have because of certain, uncertain things that can evolve in your business. And so I would say, to get back to your question now, as you move that capital structure, you start adding debt to the denominator. As you start dialing down on the ROE, you're taking away from the numerator. The numerator is very impactful because it's a small number. So the way the formula works is the more you take out of the numerator, it's very impactful. So if you take, $10 million out of the numerator, that could be 30 or 40 basis points. If you start adding hundreds of millions of dollars of debt to the denominator, that's 10, 20, 30 basis points. Next thing you know, that 15 that I talked about that we achieved last year, you're approaching again that 14% downgrade threshold. So I think there is a way that you can just kind of using a napkin and a pencil, I think you could start saying, as you dial that down. What I would say is, as I evaluate just the capital structure that's been stipulated, the 53%, in my mind, I think that's, you're talking about $50 million of debt, tens of millions of dollars of debt. I think we can handle that because, again, you're carving out one piece of this overall rate case. The whole thing was thought about together. And so I wasn't part of the settlement, but I do know that, it was probably, in totality, it was probably still beneficial to the credit. And so just the 53% capital structure in a reasonable outcome in terms of revenue requirement coming out of this rate proceeding, I think that would help maintain the current A3 rating.
Understood. And that point I hear loud and clear. I understand exactly what you're saying.
Okay.
I just want to also make sure that I understand that that's not a hard number to maintain that rating. It could be a little less. We don't know how much less, but it's possible it could be less than that.
It's possible that it could be
or
less
more than that.
Well,
obviously more than that.
Like I would say, we've worked the capital structure up just a little bit to help provide some support to the rating. And so, like I said, even at 54.5% right now, Moody's still says we're weak for our rating, right? And so that's, loud and clear, front page of the report. You're there, your stable outlook. So that means that they don't expect over the next 18 to 24 months any change in the rating. But what they're saying is just a little warning down here, and they've given it to me verbally, but they put it in here just so I've got it on record, that listen, even though you are at 15%, we still think that that's low for the rating. And so for us to take action to protect that rating, we just move the capital structure just a little bit higher.
Understood. Thank you for your testimony.
Thank you.
Commissioner Powers?
Thank you, Madam Chair. Mr. Bauer, thank you for being here. And I'm going to ask you to take off your Director of Corporate Finance hat and put on your hat. It's my understanding that you're also Assistant Treasurer for Piedmont. Is that correct?
Yes, sir.
And some of the testimony I wasn't sure I really understood. There was talk of salaries of the top executives being cut by 50%, and being made up, I guess, in some other manner. Are you aware of that?
No, sir.
You know nothing about the salaries of the top 4 executives?
No, sir.
You couldn't tell me what they are?
I could not.
Okay.
The HR department is far away from the Treasury Department.
Okay, but you wouldn't know what they made and you're the treasurer.
No, sir. I mean, I can certainly go to the proxy statement. That's a public filed document every year, and I can look up the top paid executives. But
And you don't know why it's being cut by 50% and compensation being handled a different way.
no, sir.
Okay, thank you.
Commissioner Caston?
Afternoon, Mr. Bauer.
Good afternoon.
That almost sounds like plausible deniability. I would encourage you to keep that. I would hate to have to say what my boss maybe made, but then again, we'd all like to know. So, whose credit rating is higher, Piedmont's or Duke's?
Piedmont. The operating companies typically are higher.
Number one. In your opinion, are the capital expenditures negatively affecting the credit rating for what are the capital expenditures affecting your credit rating?
They put pressure on the credit rating, and that is actually something that Moody's has also stated in their credit opinion. And really the reason for that is it's the concept of regulatory lag. And so in this instance, as we continue to make robust investments in our system for reliability and safety purposes and for growth reasons, you have to make the investments up front. I have to fund those investments. And so I'm immediately paying interest expense on the bonds. There's depreciation expense, interest expense, property taxes, all of those things that the company will incur before you're able to recover those in rates. That's the concept of regulatory lag. But that's in a period of capital expansion, that's fairly common.
But would you say that is a major driver or not really a major driver of a credit rating?
I think right now it's a caution. Again, the rating agencies want you to maintain credit metrics. And so long as you can, they just point to the fact that there's probably more leverage on the balance sheet, just given the fact that you have to finance those investments. And so it causes some pressure. All else equal, if a utility was not making investments at all, and they were just recovering rates, they would, the debt balance would not be growing. The debt balance at Piedmont Natural Gas is growing.
Okay. So what are the main drivers for your capital expenditures? Is it safety? Is it customer growth? Is it?
I think it's all of those. There are other witnesses that I think would be able to talk more in depth about the actual investments that we're making. But what I see as part of the financial planning process is I get a plan that's delivered to my office that says, hey, here's what debt is coming due in the next year that I'll need to refinance. And then here's new growth capital that we also need to finance as well. And so part of that growth capital, and is consistent with other jurisdictions as well, is there's a lot of population migration down here. Right now, this is a great place to live in the Carolinas, and so people are moving here, and so we're expanding our service territory. So there's growth capital that's being invested. Safety and reliability are paramount at Piedmont Natural Gas, and so there's always investments that you're making on your system to make sure that it's safe and reliable.
And the reason I'm asking these kind of questions is not that you care, but the utility I was formerly at, we did our first credit rating. Never done it before. I didn't have a clue. And I certainly, probably didn't have the knowledge you have, but went through it a couple times, and it was interesting. But so far, what it seems like I've heard is that the only thing that affects credit rating is the decision the commission's going to make relative to ROE or capital structure, and the sky will fall if we don't do it kind of the way y'all say do it. Or is that not what I heard?
No, I think it's a balance. And that's why I really wanted to lay out the methodology so that we could come back to it if need be. And, you know, when Moody's assigns a credit rating, and this is very similar with S&P as well, just Moody's is very clear, 50% of the evaluation is, as you describe it, Commissioner Caston, it is an evaluation of the regulatory and legislative environment in which the regulated utility operates. That's the first step. And that's a really big step. It's 50%. Then they take a look at the financials. How much cash flow does this business operate relative to the risk and the leverage that it has on its balance sheet? So I think there's a blend there, but they do, you know, they can operate separately. You can have, you know, the financials can stay put and the business risk profile can change. I think that's what Witness Coin was trying to talk about yesterday when he said there were some ROE and cap structure decisions, and I don't remember the three utilities, they were in the Northeast, and they were immediately downgraded. Well, that came right on the heels of the commission order. The company hadn't had a chance to, you know, run it through their financials and have their financial statements change. But just because their business risk profile was deemed differently, they probably took the downgrade threshold at each one of those utilities and moved it up. Then looked and said, okay, well, where are you today? And if you're not on sides with that downgrade threshold, you immediately move to the next rating down. And so that's the point I was trying to make, is that I think it doesn't all go together. I think that they can make rating decisions based on regulatory outcomes completely by itself, or they can make decisions based solely on financial credit metrics. That's what we've suffered at Duke Energy Corporation. And so, or you can have the circumstance where they both happen. And that's what I was talking to Commissioner Irvin about is, you know, there's an opportunity here that if both things were to happen, then there's the opportunity that you could have an immediate downgrade. And then as the financial results start to evolve, if they're also weak, you could suffer another downgrade.
Okay, but before I forget it, I want to, since you mentioned the, I guess, catastrophic event, earthquake or whatever like that, does Piedmont Natural Gas have catastrophic insurance? So you do have an earthquake and it
I'm
wreaks
not part of
havoc.
the risk management team. I couldn't answer that question.
Well, I can tell you the rating agencies would want to know that. They did us.
Yeah.
So, and I knew the answer to that when they asked me. But I understand y'all are bigger than we were, and we were not an investor-owned utility, so there's some differences. That said, relative to customers, customer base or customers, and I don't know if I need to say, does the rating agency care about your customers, but what is their interest in your customers or customer base?
I think they think about our customer base in terms of diversification. Like I said before, I think if we served one customer, we would be a riskier company because then our financial results would be based on that one customer. So they like the fact that Piedmont has strong diversification, that we have a good growing retail rate base. We have diversification in our both the commercial and industrial classes here. And so I think they view that as credit positive.
Okay. And I agree. But I guess what I was kind of asking is, do the rating agencies really care whether your customers have to pay more or not?
I think affordability is absolutely paramount to them, just like it is us, because they know that when affordability issues become front and center like they are right now, there is natural gas prices are high, and there are different filings being made across the country for customers to pay higher fuel costs. At the same time, utilities are also making capital investments to decarbonize their generation fleet. They're making investments in the grid. And so there's a lot of capital spend that's going on at the same time. And so I think the agencies do look at affordability and say, what does that mean in terms of the recoverability of your investments?
Okay, what I'm asking you more directly,
Okay.
because all I can go back to is kind of what I recall in my experience. In the multiple conversations you've had with the rating agencies, you know, either by phone or however you do it, do the rating agencies ask you, Mr. Bauer, are your customers paying more than they should, or are they paying too much? Have they ever asked you if your customers are paying too much, or even remotely hinted at a concern relative to how much your customers pay in conversations you've had with them?
Maybe not in that direct way. They may not have asked that direct question. What they do look at is where are our rates compared to national averages, right? And that gets back to the affordability, because we put forth in front of the rating agencies a forecast of capital. And what the rating agencies want to make sure is, as you continue to finance these new investments, can your customers, will the commission view the fact that you're maybe spending too much, you're doing too much? And so I think that from an affordability perspective, they do think about it, because at the end of the day, what they want to make sure of is that, back to these principles and in their outline on how they determine a credit rating, is can you get your costs recovered, right? That's first and foremost. Then can you earn a fair return?
My experience was, it was kind of like dealing with a big bank. They want to know all the same stuff. Something bad goes wrong, can you pay me back?
Right.
And do you have a customer base that is diverse? And is the makeup such that they were interested in people paying the bills? I never got a hint that there was any great interest in whether our rates were too high or too low, but that was me. They were not, by the way. Let me ask you this. Whether your rating is higher or lower, or your interest rates are higher or lower, customer still pays, right?
Yes, sir.
So, do you remember this table from S&P Global Market Intelligence that from 1990 to 2021, that at least to me, and I think to Mr. Rothschild at least, it appears to show, whether on the electrical side or gas side, that there's kind of been a steady decline over this period of time. Have you looked at it?
I've not.
Perhaps you should. What was, do you know, this it'd be tough to know off the top of your head, but maybe you do, what Piedmont's credit rating was in, say, 1990, 95, 2000, 2005, 2010?
I don't. Piedmont became part of the Duke Energy family in 2016. And so I'm aware of the credit ratings from 2016 on, but I'm not aware of what Piedmont's credit ratings were prior to the acquisition with Duke Energy.
Well, they used to own it, then sold it, and then owned it again. Is that how that worked?
Maybe.
So do you know what it was 5 years ago?
I believe it stayed consistent.
10 years ago?
There was a recent downgrade at Piedmont by S&P because Duke Energy Corporation was downgraded from BBB plus to BBB flat. Therefore, the unsecured ratings at the other companies, it was only the unsecured rating at Duke Energy Holding Company that was downgraded. And so therefore, as I talked about, the parent-child methodology that S&P utilizes, they also downgraded Duke Energy Kentucky and Piedmont Natural Gas's unsecured rating at one notch down. That's why at Piedmont we have what I view as a split rating between the A and the B rating. So we have an A3 rating at Moody's and we have a BBB plus rating at S&P.
So at least as long as you've been there that you can recall, the only decline in rating has been because of the parent company.
Correct.
Or decline. But despite the fact that the trend seems to be declining ROEs, does not seem to have affected the credit rating.
And I'll just tell you, my perspective here is, I think what you're looking at is a broad average. And I think that the rating agencies also look at broad averages. And so if if Piedmont stays in trend with all of those in that decline, and it's a general decline, but we're in trend, then I think that's the market moving. And I think that the rating agencies view that. Where I was trying to draw a difference is if we were suddenly far below that. and you become an outlier. It forces investors to go to the rating agency and say, hey, I bought the security over here at Piedmont. Now look at what they have. What do you say about that? That would cause Moody's to say, yeah, we should evaluate that. I don't think it would come in that order. I think the order would be written. I think it would be digested. And I think that, like I said before, I think Moody's would go evaluate it. But I think that so long as the business environment stays consistent and predictable, that's what they state in their methodology, consistent and predictable. So this general trend, that's still consistent and predictable, so long as your financial metrics also stay in line.
So Moody's looks at this general trend and realizes that, well, that's kind of predictable and stable. So if it continues, this commission decides to continue that downward trend, then Moody's shouldn't have a big problem with that. Is that what I'm hearing?
I think so long as it stays within a realm of reasonableness, and I think that it still is consistent and predictable, then I think that Moody's would look at that as still fairly constructive regulation in the state.
Makes sense. And I guess the big debate and question is, what is reasonableness, right?
That's right.
And kind of going back to when we did our first one, and I didn't know what I was doing, but we got through it. My general sense was, or at least what I had been told by the folks working with us, helping us, was since we had to go before the county, we had an appointed commission, not an elected, and we had to get an elected body to approve our bonds. So our rating could not, or I was told, could not be higher than Mama in the county. Now, apparently that's not the case with Piedmont and Duke, but the parent company can affect Piedmont's rating, obviously.
You can at S&P.
Now, when Duke had some, I guess, credit rating decline that affected Piedmont's credit rating decline, did the Public Service Commission of South Carolina have anything to do with Duke's credit rating decline?
No.
Okay. Just want to make sure. I'm getting there.
Okay.
So going back to the proxy group, I know, Mr. Hall pointed out the different tables, and I've really tried, like the rest of the commissioners, to make sure I'm understanding what I'm hearing, first of all, and trying to piece it together, because I've heard someone say, well, so-and-so's cherry picking. Actually, I can't remember who that was, so I don't want to mention the name. But when I look at the proxy group or hear about the proxy group, and certainly, Mr. Coyne talked about the proxy group a lot, as did the others. There does seem to me to be an inclination to absolutely endorse or agree with the things in the proxy group that help your case, but in areas where it doesn't, say that capital structure or the rating. I mean, I didn't see anywhere in the capital structure where it said in the proxy group that, man, if you got less than an A3, it goes to hell in a handbasket. Excuse me, strike that. It goes to heck in a handbasket and the world ends. I didn't see that in that information. I didn't hear that in any testimony. Yours is the only one I've kind of heard say that. So is the proxy group a good proxy group, or is it not? Do we use the stuff in the proxy group, or do we not?
I would think that the proxy group is more applicable to setting ROE. What I try to talk about in the capital structure is those are real numbers that's a real rating that's tied directly to the capital structure. So what I was coming back to is, how important is that A3 rating? To me, it's very important.
Understand.
And so that's the point that I'm making, is that the proxy group, I don't think that it's useful when determining capital structure. I think it's useful when you're trying to determine what is a fair and reasonable return on equity. Then you would look at a proxy group and say, well, how is it amongst others? So I've listened to all of the testimony, and I agree that everybody has a point of view there. What I'm trying to simplify in the capital structure discussion is that it's real numbers. This is real capitalization.
Well, it seems I heard Mr. Rothschild say something very similar, that, hey, I'm talking about real market. I mean, this is what the investors are saying. So, I mean, he said something very, very similar. So should I ignore what he said that was real and real market and accept what you say, or should I ignore what you say and accept what he says, or should I ignore you both, or should I accept you both? Do you see the confusion?
Oh, absolutely. And that's why I'm not testifying on behalf of ROE.
Okay.
That is not my area of expertise. I don't run financial models. Capital structure to me is different. They are related. And I heard Chair Belzer even say at the beginning of the hearing, she puts them together, and you should. They are very related. But when you think about awarding them, one is a fair return, and the other one is the actual debt that's on the balance sheet of the utility that you're regulating.
And I'm certainly not trying to put words in Attorney Hall's mouth, because he did his own thing, because I was trying to follow it all too. But and you know, I've kind of studied this a lot. We've kind of been through this enough now to where it is math.
Mm-hmm.
It really is math. You know, it's why the capital structure does matter. You know, whether it's 51% equity, 52% debt, or 51% debt, or 52%, whatever it is.
Mm-hmm.
And that ROE matters because the debt pretty much fixed. I mean, you know what it is. You can take, an average and come up with that. So those things matter. So the bigger, I'm not going to go through it. You understand it. I think I do too. So when I think about that, what is Piedmont current capital structure?
As of March 31st, it was 54.5% equity.
Okay. And what was, and this was already stated, in the 2021 RSA, what was that? What was approved?
I believe it was just north of 52%.
Right. And in the information that we have here, North Carolina is 51.6%, South Carolina 52.2%, and Tennessee 50.50%. Are those, I don't know if I'd call it divisions, but are the folks in North Carolina and Tennessee going to collapse? Is their credit rating going to be affected? Is Piedmont's credit rating going to be affected?
Piedmont operates as one company, right? So the credit rating is for the combined 3 states.
Right.
And so those are the allowed capital structures in each of those jurisdictions.
So what I'm hearing, though, if this commission does anything less than 53.5 or 55 or anything close to 50-50 or anything close to Mr. Rothschild's, the world's going to end. We're going to be run out on a rail or something, and bad things are going to happen. I don't see how both of these can be true. Which one's false, which one's true?
I'm supportive of the 53%. I don't think that the world would fall at 53%. The example that I was using where I thought things could get dire for the rating would be just using Mr. Rothschild's recommendation of literally flipping the capital structure from 54.5% equity to 54.5% debt. That's where I was drawing that conclusion. And so I think that, moving from 54.5% to the agreed upon 53%, I think that is still supportive. I think that will still support the A3 credit rating.
If we opted to go with what Tennessee agreed to, which obviously it is, 50.5% equity, which would make it 49.5% debt. Why did it not make the world end or markets collapse and y'all's credit rating crash when that happened there? Why would it only happen if we did it?
Well, like I said, it's all of those are allowed capital structures at each of the jurisdictions. The actual capitalization structure today is 54.5%.
Okay. Look, I'm really trying to get my head around all of it. I know this is going to break your heart, but I think I have no more questions. Thank you very
for your
much, Mr.
questions.
Bauer.
I appreciate it.
Commissioners?
Madam Chair, before we go further, I know the witness has been referring to a Moody's exhibit. I think he's holding his hand, or has been. Is that in evidence yet?
No, sir.
Can we
I think that's coming.
ask it to be entered into evidence since he's testified from it?
We intend to
I
introduce
think that's
that
coming,
on
Mr.
redirect.
Commissioner. We'll get
Thank you
to
very much. Thank you.
Commissioner Thomas. Did you have your light on?
I did. Thank you. Everybody always has a hard time hearing me, so let me make sure I have this thing right in my face. Okay, first of all, I'd like to just ask you a question. Either I misheard or misunderstood or you misspoke. So you were talking about the agreed upon equity ratio in the stipulations, 53.5%. And you've referred to it at 53 as a few times, but that's not my point. So, but the current is 52.2. And when you were walking through explaining what would happen to move forward, you made it sound like you were going to be having to deal with a worse situation, like you're going to have to be issuing debt, as opposed to it being a better situation in terms of the allowed return currently versus what's in the stipulation. Do you understand what I'm asking?
Not exactly.
Okay, well, you said basically that you would have to be able to work yourself down to the 53.5.
Yes.
Wherein, in fact, right now, you're allowed 52.2.
Yes.
So that would be, most people would say it'd be an improvement. So it's not a working down to, I don't think.
Because it's an actual, and where we actually are today, it would be working down to 53.
Today. Okay. And so that brings me to another point. And you keep talking about equity as a real number. It is, but it's a real number that changes every day, every month. And the company, as you said, typically picks March 31st as a snapshot. And is that not kind of at the end of the earnings period for a gas company that sells a lot of gas in the wintertime? And therefore, everything else being equal, then the equity is going to be a little bit higher at March 31st than maybe September, October 31st.
Again, we picked the March 31st date because it's an established process that we have. We've been using and measuring on that date since 2019. And so as we put this case together to also try to get a recent number, we thought that that was the best number to start with.
But is that not typically a time when the earnings have flowed through to the balance sheet, when your equity would likely be higher than a lot of other months?
I think as long as you continue to measure it on the same date, year after year, then I think that it gives you a decent comparison.
Okay. Sometimes people use averages to help even those kinds of things out because it is a real number
Right.
that changes every day. Let me ask you a question. You mentioned the S&P downgrade at the parent company that flowed through to some degree to South Carolina and changed Piedmont, which impacts South Carolina. So the rating from S&P declined, which may have caused interest, if some financing happens, may cause the interest rate to be higher for Piedmont due to no fault of ours or South Carolina operations or South Carolina customers or anything like that. Is that true?
I think that it is true. What I continue to hold on to the A3 rating for is that when we take Piedmont to market, we hold the higher rating and investors will hold to that higher rating as well. So that's why it's important for me to maintain that A3 rating so that every time we go market Piedmont Natural Gas, we market it as an A3 rated company.
Okay. You market as such, but in the meantime, the both ratings are out there for everyone to see. People, I mean, I don't know. It just picking the one that's better, I can see how that could be good for the customers, but is that open and honest and fair with the investors?
It is, and it's common practice. There are split ratings all the time. That's why there are typically three rating agencies. We don't have Fitch, but often Fitch has been in the market the tiebreaker, because if there's a difference between Moody's and S&P, the second rating, whatever it is, will be the tiebreaker. For us, we go off the higher rating when we market it, and I can tell you that we price the bonds comparative to other A3 rated utilities. And so when the syndicates of the banks go out to market the bonds, they go to investors and try to determine what is fair value for those bonds. And so investors will typically look at other comps, things that are of similar credit, other LDCs, similar size, capitalization, and they will determine what is a fair value for this bond. And I can tell you, we just came out of market with Piedmont Natural Gas. As we do that, all of the trading comps that we use to determine what we thought that was the fair price to price those bonds were A3 rated companies.
Okay. The company started out asking for 54.56, and then the settlement came in at 53.5, and the current allowed is 52.2. And if you look at the three states, South Carolina at 52.2 is the highest equity of the three states, and you're looking to go even higher. So then South Carolina would be definitely the outlier, the highest of the three Piedmont states. Do you agree in terms of the allowed?
They would be. I would argue that we would also be arguing for higher ROEs when we go in for rate proceedings in Tennessee and North Carolina as well.
Right. And you may or may not get that. And, you know, everybody asks for everything, and who knows how it's going to all play out here or anywhere else. But my concern is that I just, I just want to make sure we're being fair to South Carolina customers. That's part of the package. We want to be fair to everybody. We want to be fair to the company, to the big customers, to the little customers, to the shareholders, everybody. But when I see these numbers going up, it definitely gives me pause for concern for the little guys in South Carolina that don't have much money. And some people have, they've talked about different numbers and which ones are reasonable. And I thought that the 52.2%, I know ORS, that was the one they recommended, But I thought that maybe I can't remember, some other people have said that 52.2 is a reasonable number. Do you have any statement to make along those lines?
I think it's reasonable.
Okay. I think that's all I have. I appreciate it.
Thank you.
Thank you.
Good afternoon, Mr. Bauer.
Good afternoon, Chair Balzer.
Are you familiar with this cross-examination exhibit that Mr. Jeffries used with another witness? Do you know what we're talking about when we talk about North Carolina, Tennessee, and
Yes.
South Carolina? Okay.
Yes.
How familiar are you with the RSA proceedings?
Not very.
Okay. Based on the last rate case, do you know what Piedmont's capital structure and ROE were?
I believe if it's the same as what's in the RSA right now.
I'm talking about the last general rate case, which would have been probably about 20 years ago, maybe.
No, ma'am.
Okay, but you know about what's in the last RSA.
I do.
Okay, and this 52.20 and the 9.80 ROE was from the last RSA. Is that correct?
Yes.
And do you know if that was fully litigated with experts on either sides, or if that was a settlement?
I do not know.
Okay, that's fine. I want to just be clear. When you say we are weak for our rating per Moody's, give me a very basic
Sure.
description of that, please.
It's the financial credit metric.
Okay.
Because of the way that they rate the legislative and the regulatory environment, the first half, it's already as high as it can get. So when they say we're weak, they're purely talking about the financial performance of the company. And when I talk about that, it's the FFO to debt metric. And so because we achieved 13.5% in 2020 and 15.0% in 2021 with a downgrade threshold of 14.
That's that FOF to debt you're talking about.
FFO to debt, that's
Okay.
right. That's their key metric that they always come back to. So their expectations of an A3 that they say in here is somewhere between 15 and 16%. And because we have delivered 13.5 and 15, that's the premise for why they say you're weak for your rating.
Okay. All right. Thank you, sir.
Sure.
Commissioner Caston?
Commissioner Caston.
I'm sorry.
Sorry.
That's okay.
Commissioner Carolee Williams?
Thank you. Appreciate it. My questions have to do with the idea of a cost-benefit analysis.
Okay.
Did you consider providing one?
No, ma'am.
Tell me more about what that is from your perspective.
Well, until the hearing today, I've supported a few rate cases. I've never done a cost-benefit analysis. I've not heard it in discussion. And so I'm only going to summarize for you what I've heard here in this courtroom. And that is taking basis points off of the ROE would, as you apply that weighted average cost of capital to the company's earnings base or rate base, as you lower the ROE, that determines the cost of capital and the overall revenue requirement. So I think what they were trying to say in their cost benefit analysis is by saying, okay, if we shave 200 basis points off of the ROE, then the overall cost of capital is reduced, and that would, as you flow that through the revenue requirement, would lower customer bills by about $10 million. That's the way that I understood it. And then you would say, well, what's the cost then of that? So the benefit is the $10 million savings. What's the cost? The cost would then be, what's the cost of the downgrade? And so in order to get that 200 basis point reduction in ROE, the rating agencies would respond. They would assign a new rating to the company. I would take the company to market. We would price new securities, and that would come at a rate. And I would try to compare whatever that new rate would be to a recent rate and say, well, there's the difference between the two. And then price those basis points over the amount or the notional amount of the debt and compare that to the $10 million back here.
Right.
I think that's the premise of the computation. I've never done that, but I think that's what they were trying to get at.
So you've never completed one?
No, ma'am.
Okay. my understanding, slightly different from what I heard you say, was it was more of an estimation, an expectation kind of analysis, as opposed to a real life after the fact.
I think it would be, because it's, you would have to estimate what is the new rating going to be, and what would that cost of debt be under that new rating. You wouldn't know that until you actually took that credit to market. And so if you were to do that analysis today, you would have to make an assumption of, would it be a 1-notch downgrade? Would it be a 2-notch downgrade? And how would Piedmont Natural Gas fare in, call it normal market conditions, at 1 notch at a Baa1 and a 2-notch at Baa2? How would those securities price? If it was 100 basis points different, or 50 basis points, or 20 basis points different, you just do the math. It's multiply the 20 or the 50 or the 100 basis points times the notional amount of the new debt. But keep in mind, we also finance the company every year. It's not just one time.
If this commission were to request that in the future, who would be responsible for overseeing a cost-benefit analysis in
I think
the
that
company?
I think that my team could do that, because I think that we have more access to bond data. Issuers are in the market almost every day. And so we would look for other similarly, situated companies at different ratings. So I would go try to find LDCs rated at Baa1 and LDCs rated at Baa2. I would look at what is the type of debt and the tenor of which they're issuing. We tend to issue 10 and 30-year paper. So I would want to see 10 and 30-year comparables at different ratings in different market conditions, and then be able to estimate and say, here's what I think the rating differential would cost you. And like I said, I think we're in a period now, unfortunately, we've just had very cheap financing for the last couple of years. We've had very low U.S. Treasury yields, and we've had very low investment grade credit spreads. That spread has doubled in the last 6 months. So it's gone from roughly 100 basis points to 200 basis points. And so that's where I think if it continues on this trend, I don't know, I'm not an economist, I'm not going to pretend to be one. But if we continue on this trend and that investment grade credit spread continues to widen and get back to more historical norms, then I think the rating differential will really start to show itself. I think they were compressed over the last couple of years, and I think today they're widening, and it's definitely visible. But I think that, to answer your question directly, I think that my group could probably pull that information together.
Does it sound like a request that would be onerous if we were to require that in the future?
In the future, I don't think so, with plenty of notice, because we'd want to give relevant data, right? So Piedmont Natural Gas comes to market 1 time per year. And so if that request was made, say, tomorrow, I would have to use historical data, because, and again, I'm pointing to the fact that the market a year ago is very different than the market today. And so I would say in the future, it's I would say credit spreads have come back to what's more mean reverting. It's kind of come back to the middle of where it has been traditionally. So in the future, I think with enough notice, if that was something the commission was interested in, I think that we could provide that.
Thank you. No further questions?
Thank you.
Thank you, Commissioner Caston.
Commissioner Caston?
Actually, I was going to ask what she asked, but I'm going to build on it now, if I may. I thought I had heard you say earlier that you were opposed to benefit cost studies. Did I hear that, or did I not hear that?
Again, when I was talking about the cost benefit earlier and just including it in part of your testimony, it's, you're trying to trade things, and you're trying to say, well, if we do this, then that, and it really becomes more of a mathematical formula. And what I was trying to impress upon the commission is that capital structure is not something that you just sort of wave around. It's the actual debt on my balance sheet. And so that's why I've continued to come back and say, we could do an analysis just to say, what is the difference? What is the cost of different ratings? What does that cost you when you go to market? The point that I was trying to make is, when you set when you set capital structure, it's really trying to tell me how much debt do you want on the books of Piedmont.
Okay, but I can only speak for me, not the rest of the commissioners, but I don't think there's an interest in just going through an exercise. unfortunately, Mr. Rothschild's not up here because I wish I would have asked him, all right, you did that in Connecticut. How does that work? What do you do? I mean, I've got my own concepts, and I don't think it would be just looking at stuff now, but there's also got to be some looking out, some projections. Like when we did economic engineering analysis, you got to look at that. You got to look at the cost of money. You got to a host of things.
Right.
So you just got through saying you've never done one. Does Piedmont have folks internally that has ever done a benefit cost analysis that looks at least from my perspective, looking at projecting if the ROE was whatever it was, and it was 50-50 or 51 equity, 49 debt, the interest rates are going to do this over the next 1 year, 2 years, 5 years, 10 years. Does Piedmont have people in place internally that can do that and are qualified to do that, or would that be something that would have to be contracted out?
No, we have a financial planning analysis group that focuses on Piedmont Natural Gas. I'm certain that within their financial models, they can make changes to assumptions and evaluate results.
And it seems like Mr. Rothschild kind of got beat up a little bit for that because he hadn't done one, but apparently no one's done one. And it seems to me like it would save everyone a whole lot of time if we would just go ahead and do that kind of up front and submit that with whatever we're going to be doing relative to rates, RSA, anything, because that's the crux of the matter, is it not?
I think when determining ROE and cap structure, I think that is the crux of the matter. I think that there is a qualitative aspect as well. That's a math exercise. And I think that it also gets to access to capital. That's hard to quantify. And so, because you can continue to change that, the assumptions, and you can create cost and you can create benefit. And in this case, I would argue that it's probably, in this math exercise, it would always win to say downgrade the utility and save the customers a few dollars on ROE on their bill. But I would caution you there to say, but be careful just saying we're just going to downgrade the utility. Because like I said, it's very hard to get that rating back in time. And when you get too far down, folks don't show up. And that was evidenced in a couple other utility issuers that needed capital at a time of financial distress, and there were no investors there to loan money to them. And so I would say that would be absent of any financial analysis that we would do here.
Absolutely.
That would be very hard to quantify.
I'm sorry. I absolutely agree. And I don't think there's anyone on this commission that has any interest in doing anything to damage the financial stability, the credibility, or anything of Piedmont. I certainly don't. That's not even the issue here. To me, the issue here is just simple fairness.
Right.
Understanding it. So whatever benefit cost analysis or study that is done should look at all of these things, which I believe what you just said absolutely could be looked at too, because we're having to deal with all this stuff and all this stuff. And it would be very, very useful to just start from that point. Let's just put the cards on the table, man up so everybody can see them, save everybody a bunch of time and trouble. Does that make sense to you?
It does, so long as it's viewed as, all together. Meaning that's going to produce a number, but then you have to say, well, what do I get for that? Well, you get a lower rated utility. And so I think as long as the conversation is holistic and you think about, here's the cost benefit, here it is right here. A downgrade's going to cost this, 2 downgrades going to cost that. Compare that to a lower ROE, what does that do to a customer rate today? Then you have to look at the long-term financial stability of the company and say, is it worth it? That's the decision that you would make.
I believe that's what we're saying, that a benefit cost analysis needs to look at.
Yeah, I
And
think it's step
clearly we
one.
know, and I don't know if the one in Connecticut was done perfectly or done well. I don't know. But clearly someone's done it somewhere. So it's not like, I don't think we would have to start from square one.
Yeah.
I would encourage that, because transparency really can be a good thing. Not always a comfortable thing, but a doggone good thing. So let's just do it, because I want to make sure we look after Piedmont also. I want to make sure of that. But I want to look after the customer too, and the industry. I need as many facts, honest, open stuff as I can get. So the more like this we can get, the better we all are. Would you agree?
Wholeheartedly.
Let's do it. I say let's wrap and go home. Sorry, Madam Chair. Sorry.
Commissioners, anything else from Commissioner? Mr. Jeffries, redirect. Microphone.
Thank you, Chair Belzer. I'll try to be brief. It's been a long day. The first thing I'd like to take care of is, Mr. Bauer, throughout your testimony today, you've been referring to a document. I believe it's this one, correct?
Yes, sir.
Okay, I'm going to put that on the overhead. Can you tell the commission what that document is?
This is a credit opinion published by Moody's Investor Services on Piedmont Natural Gas Company, dated July 26, 2022.
Okay, so it's relatively recent.
Hot off the press.
And what's the purpose of that document?
The purpose of that document is to provide credit analysis on behalf of Moody's, and the purchasers or the users of this document are investors in fixed income securities.
Okay, so, I mean, is it fair to characterize that as, I'm sure this is a bad analogy, but I mean, is it sort of the Moody's report card on Piedmont's creditworthiness?
That's what it is, and all of their rationale for arriving at the A3 rating.
Okay, and why is that? Why have you been referring to that today?
I've been referring to it today to help the commission understand the rating agency's point of view and how they evaluate the creditworthiness of a utility. To help them understand that there is both a qualitative and a quantitative aspect to their analysis, and understanding what the specific criteria within the qualitative are, because we've had a lot of discussion over the past 2 days around what's fair and reasonable. And I wanted to make sure that they understood that a long-term fixed income investor in Moody's looks at the long-term creditworthiness of a company. And so they look for consistency and predictability in rate making. I wanted to make that point. I also wanted to introduce how exactly capital structure is utilized in terms of debt leverage on a company's balance sheet. And any changes to that debt balance absolutely changes a key credit metric, FFO to debt. And that FFO to debt metric is a key driver in the rating that's ascribed here.
Is there anything about this report you'd like to point out to the commission that you haven't already discussed in your responses to either Mr. Hall or the commissioners today?
No, I don't think so.
Okay, thank you. Madam Chair, we would move that this document be admitted into evidence as, I guess it would be Piedmont Bauer Redirect Exhibit.
Well, it would actually be hearing exhibit number 11, but you can call it what you want.
Let's call it hearing Exhibit 11, if that's all right with the chair.
Madam Chair, I just ask if it's the whole document.
Is this the entire document?
Yes.
Okay, thank you. Hearing document will be marked for identification as hearing exhibit number 11 and accepted into the record of the case.
Thank you, Madam Chair. Next, I'd like to, Mr. Bauer, you've been asking a number of questions about this document. which was utilized earlier and across from Mr. Rothschild, and it's a summary of Piedmont's current allowed ROEs and it also includes capital structure
Okay.
information on there. You see that?
Yes, sir.
So before I ask you about this, I want to ask you another question. Is managing Piedmont's capitalization, capital structure, is that a static or a dynamic exercise?
Very dynamic.
Okay. So what do you mean by that?
The capital structure changes literally every day.
How does that happen?
Well, as Commissioner Thomas pointed out, there's seasonality in earnings. That's a factor. There is timing of payments to vendors on our, as we pay our vendors, there's receivables from customers that come in every day. So the timing of inflows and outflows of capital change that. Capital markets transactions, so big bond deals. I'm trying to be very efficient with the capital markets when we go to market. So if I have $400 million of debt that's needed by Piedmont over the course of the entire year, I'll do it all at one time. And so that obviously changes the capital structure dramatically the day following a bond deal. And so it will look like there's a lot of debt. And then it will grow back as retained earnings are kept at the company. The timing of any equity infusions from Duke Energy Corporation would increase the equity percentage. And so that's why we try to manage the capital structure over longer periods of time and certainly not day by day.
And to be clear, your job does not involve working with hypothetical capital structures, correct?
No, it's real money.
Okay. So I'd like for you to look at, if we could get this exhibit back up. So this shows the results of a couple of rate cases that Piedmont had in North Carolina and Tennessee recently. The North Carolina one concluded early this year, and Tennessee included in the spring of last year. Was Piedmont's actual capital structure at the time these rate cases were addressed and resolved, was it lower than it is now?
Yes.
Well, could you explain that to me?
If I don't have them as of those dates, but I do know that as of March 31st of this year, it was 54%, and that number had been increasing.
Okay.
So it was arguably lower as you look at some of these other dates.
So do you think these equity bands that are reflected for North Carolina and Tennessee, do you think they're reflective of something close to Piedmont's actual capitalization at those points in time?
Yes, that's reasonable.
So is the explanation between why is it 52 in the RSA and less than that in North Carolina?
Yeah, based on those dates, I would say that that's probably closer to what the actual capital structure was at those points in time.
Okay. And in this case, we've been discussing a stipulated ROE of 9.4, correct? 9.49, excuse me.
There you go. Yes.
It's late. And that's substantially lower than any of the ROEs that are reflected on this exhibit, correct?
It is.
And does Piedmont, to your knowledge, evaluate possible settlement positions as a whole, or do they just focus on single issues and only resolve those within bands that they're agreed to?
As a whole.
As a whole, okay. So, in your opinion, could the stipulated ROE of 9.49 and the stipulated equity band of 53.5 and the other accounting adjustments that were agreed to, those could all be interrelated in terms of what Piedmont chose to accept and to push back on? Is that correct?
I would agree with that.
Okay, thanks. I'd like to address the CBA issue one last time, and I feel like it's been beat to death, but there's just two questions I want to ask about it. Do you agree with me that the CBA exercise would essentially be a multivariable equation?
The CBA.
In order to conduct that cost-benefit analysis, you said it's math. You can create a formula, but the formula is going to have holes in it, and somebody has to fill those holes in, right?
Full of assumptions.
Okay,
yes.
So you might, it's not just one calculation in theory. I mean, I suppose if commission gave you presumptive numbers, it would be one calculation, but you would have to know
Yeah,
kind of things that we won't know with certainty until the end of the case.
that's right. Yes.
Okay. All right. I just wanted to clarify that. And does the CBA address in any way the impact of a reduced ROE on the company's ability to raise equity capital?
No.
Okay, so it's only comparing kind of the savings from the reduction in ROE to the impact on the debt piece of the capital structure, right?
As we've discussed it today, that's correct.
Right. And Mr. Hall talked with you about the Hope and Bluefield standards earlier today. And
Right.
I think his recitation was that the legal requirement is that the company be allowed an opportunity to earn an ROE commensurate with companies of similar risk. Is that correct?
Yes.
So that would be a factor, that would be the larger context in which you would have to view the CBA, right?
That's right.
Mr. Hall had some discussions with you about the proxy group calculation of equity bands. And he cited a number that Mr. Rothschild had put in the record. Is it your understanding that that calculation was a calculation of equity ratio at the holding company level?
That's the way that I understood it.
Okay, and do you also understand that Mr. Coyne did a calculation calculating the 3-year average proxy group equity band at the operating company level?
I do know that he did that, and that would seem more appropriate.
Okay, we'll get to that in a second. For the record, Mr. Coyne's recommendation was 55.7%. Does that sound right to you?
Please answer, not
Yes.
just nod your head. Thank you.
Yes.
Are we setting the equity band in this case, is this commission setting the equity band in this case for Duke Energy Holding Company or for Piedmont, the operating company?
Piedmont, the operating company.
Thank you. I don't like to put another exhibit up on it, and this is previously admitted. This is the S&P Global report that we'd looked at previously. So I'd like you to look at the sixth column, which is the average ROEs for 1990 to 2021. Do you see that?
Yes.
Okay, and if you start at the top, you see some numbers that start with 12, and I'm not asking you to study each number, but then they drop down to 11, and then they're the high 10s, and then they continue downward through about 2015, correct?
Yes.
And it's not perfect. I mean, sometimes they bump up and then bump back down, but there's a clear downward trend during that period, isn't there?
Yes.
What were interest rates doing during that period?
Declining.
Okay, would that have an impact on, or could that have an impact on natural gas distribution ROEs?
I would assume so.
Okay. Now, when you get to 2016, and I'd like you to just focus on the annual numbers,
Okay.
rather than the quarterly ones. From 26 forward, do you discern a clear downward trend?
I do.
Well, do you? Let's look at that. So 2016, and I apologize, I'm having to lean over to look at this.
Yeah, sorry, I'm following you here.
So,
Okay, thanks.
yeah, 2016, is that a 9.54 average?
Yes.
I'm sorry.
Yes.
Okay. But then 2017 is a 9.72, right?
Right.
So it went up. 2018, we're back down to 9.59. Is that correct?
Yes.
2019, we're back to 9.71.
Yes.
And then 2021, we're at 9.58, correct?
I think so. It's
Yeah, read
being
that.
cut off there just a little bit.
9.56, I think. So it's kind of bouncing once we hit 2017, right? It's up and then it's down, and it's up
Yeah.
and it's down. And I think we can all see that 9.58 is less than and where we started out in 2017. So I think it's fair to say that, you know, perhaps overall there's a continuing downward trend, but it is going up and down during the last 5 years, right?
Right.
Okay, thank you. I think that's all the questions I have, Madam Chair.
Thank you, Mr. Jeffries. Anything else, commissioners? Mr. Bauer, thank you for your testimony and your patience today.
Thank you. I appreciate it.
Ladies and gentlemen, it's almost 5:40. Everybody ready to go till about 8? I'm just teasing. There's some head shakes out there. I think we have 3 witnesses left that we've identified. Is that correct?
Well, I thanks for bringing that up, Madam Chair. We have one more witness that Mr. Hall has reserved cross-examination on.
Correct.
The other 2 are settlement witnesses, which we are happy to put up. One of them, I have to caveat, is not feeling well today and has been back at the hotel, so we might have to arrange for her to testify virtually if she's still feeling badly. But from a party perspective, we've all stipulated to the admission of that settlement testimony into the record. So it's really a question of whether
Everybody has?
Yeah, everybody has.
Well, can we let you know in the morning from the commissioner's side?
Okay.
Are parties wanting any closing arguments? If you do, I would say limit it to no more than 10 minutes. If you decide you want that. So y'all figure it out, because one person is not. If one does it, everybody's going to do it.
I think that's probably true. So we're fine with waiving closing if the other parties are.
Okay. Well, we will start again at 9:30 in the morning. Everybody have a good evening and safe travels wherever you're headed. Thank you.
Thank you, Madam Chair.